Good morning, Friday Trader friends. We are here on Trade Live with IG with sellable Chris Beach. Morning, Chris.
Good morning. Is that even the right word for a Friday morning? I don't know.
Well, it's dry. We've got another day of sunshine, I believe so, coming up.
It's a bit nicer, yeah, than yesterday. A bit nicer than it was yesterday.
Yeah. Although we did have quite a nice, afternoon, evening sort of sunshine, warmth come through. But it's still for August.
Yeah, well, it was dark when I got up and went to work yesterday morning, so it's that kind of thing now for the next 9 months. That's my daylight commute gone. So.
You're so cheerful, Chris.
I am really. It's that kind of nothing else is going on except one thing that matters.
Now, is it that same feeling as everyone is sitting down to Jackson Hole? Of course, we have that big event coming up. But ahead of that, do we have a quick rundown of what your day is looking like? Producer Phil, we're being told that the new studio is almost ready. We've got like a new, won't say too much about the walls because I want it to be a surprise. But it is going to look very different. Plus today we've got Pete Ward and Bill Blaine as well. What is the rest of your day looking like, Chris?
Apart from waiting to see what Jerome Powell says, we've got to finish off the morning call, and it's a bit of a quieter day actually. I'm still catching up with emails from away on holiday, so that will also take up my time. It's time to delete 1,000 emails. Really.
On that note, shall we look at Jackson Hole before or after overnight action? Should we do it? And then we'll be right back for this. Right, good morning. Let's get us across the Jackson Hole preview. Everything you need to know. Of course, that's a big thing will be JP's keynote speech there at around 10 Eastern. And it's probably going to be a swan song.
It is. It's his last go. Did you know Jackson Hole is in the same state as Custer's last stand in Wyoming? I learned that from Bloomberg yesterday.
Oh, so I didn't know this.
They're calling it Jerome Powell's last stand, as it is, of course, because it is his last go. And that, if it was my last, I'd be tempted to throw in a hand grenade. But maybe Powell discretion is the better part of valor. Who knows? But it's been obviously a week where you've had president picking on another Fed governor. You've had Alan Bullard, who was on the Fed and is now an academic and is clearly advertising for the top job, saying that they should cut by 150 basis points by the end of the year. This is literally The Apprentice in real time. They're all auditioning for Powell's job, and he has to go out there, give the keynote, give the opening remarks, and then quietly retire to the sidelines. But I think he might go for the combative approach and the defense of the independent central bank and say, we're here, we're not moving. We're not going to do what the president wants us to do just because he thinks that's what should happen. I think that might be interesting, really, especially with the market, pricing in, what was it, 79% chance of a September rate cut. So there's a lot to play with here, but you definitely get the sense from markets that we've drifted lower all week on the Dow. Obviously, tech has been much more heavily affected. Everyone's just waiting for this now. It's been the only game in town all week. PMIs yesterday, no one cares. It's all about what happens at 3 p.m. Today.
Chris, I'd like to see him do a drop mic at the end.
Doesn't he? This year was it this year with the people that invaded the stage? That something door? That's the kind of thing he is capable of doing. He delivered that bravura performance last month, really, with the renovation stuff and the president. The Italian Prime Minister, she became the eye rolling and the she gives everyone else in meetings. But the two of them together could do really, really well. But I think it's going to be a very, very tough ask for him.
I know, back gently when Biden went off into the distance.
Yeah, well, she has fought. She's very good at. She's a bit of a Trump whisperer as well. I think really her and I think at the moment. So
what's also interesting is that these cuts, majority of deep rate cut advocates very likely to emerge on the Fed's policy making committee magically, surprisingly, after he's gone. Also, the dollar steady, firming though. This is after the Cook story, after giving up much of the ground it had in the previous session. Also, we had a few bits and bobs yesterday. Walmart.
Yeah, it was a very great set of numbers from Walmart. Very, very sort of disappointing. And of course, the warning there that there was tariffs. What's saying it's watching squeezing its profit margins. I mean, no supermarkets in the UK and the US, the same thing. You know, they get all this opprobrium heaped on them. Wafer thin, and they're thinner than an Nvidia. But they're seeing these tariffs come through, and really, so far it's been gradual. They know it's continuing, I think, and this is kind of the drumbeat of every earnings report and every sort of market, that this thing is getting more and
more. Walmart also out here, is pulled in part those shares lower. Interesting that there's a spotlight as to which segment of it. Every a pullback, so that's indicative of the emerging really cracks.
It is, but you should look at the run it's had over the past 2 years. We've gone from nearly $50 a share to almost $100 a share. This stuff, it still beat. It fell short of expectations, but it raised guidance for the year, and it managed to take more market share from rivals. So it's not all bad. It's the question everyone's asking is, when did it go up? Maybe they're starting to, and yesterday's PMI did show that. And when, if they do, how big will it be, and can cope with this? And I think the Walmart is kind of the canary in the coal mine at this point. Will US companies continue to eat these tariffs, or will they have to pass them on? Here is one of the signs that next, and I said this last earnings, next will be probably the one where they do begin more.
Percent there for the session. Another one that tanked yesterday, WH Smith. Loads of positions. I think the drops fallen by 2. Be careful.
I look at the earnings growth in Smiths, and that's been better over the. There's no dip. North America, one of the big drivers. They must pay a fortune for, by the way. It's not about the high street now. They've left the UK high street after however many decades, more than a century, isn't it, or something. But it's never good to have to release an RNS that says there's accounting error. the candle there, 42% down was the
Mm.
closing on derivatives, which takes it back right back to March. 21 at about £19.80, and just below £20. But yesterday was the impressive shove. But I think it will be interesting to think, oh, this is where it bottomed in 2020. Some division, is it overdone? It's very dangerous to ask. Orphans or jumping in blindly, but maybe we'll see something emerge in the next few days.
At the moment, it still looks a bit like a trying to. Of course, other than the Jackson Hole previews that we find across the internet, is did you see the story about the chief of Microsoft's AI division saying that they are increasing some? And Phil, I don't know whether you can throw this up. It's in the Time. Mr. Lehman saying chatbots are causing psychosis.
We'll just keep talking to ChatGPT, and the thing is, I think it's been shown that AI, the systems that people are using respond with praise. They tend to sort of contrary. It's like talking to Putin. You don't ever say anything rude to him.
They don't ever push back.
No, exactly, and that's. They thought they were going to become a multi-millionaire because the chatbot was giving him references in his suit against his employer and all this kind of thing. And it's just the AI is validating it, and it's not good. I think
in this instance, if you scroll down that story, it got to the point where someone was asking ChatGPT, and got to the point where after a lot of ChatGPT, agreeing with it, came up some crazy figure like, yes, you ought to be earning, commanding something like 6 billion. It was a very large figure. Interesting stuff there. Let's cross over to the Financial Times as well, because this is something that's very close, something I watch very closely, because for those of you that aren't aware, we've got the first episode on the YouTube platform under playlist. On the FT site, the EU plans for the United States. Now, not a surprise. What was that the US
we've got this, the dollar already being the world's reserve currency, the denomination. You saying we need the digital euro to protect ourselves, to protect the euro across the continent. So that's the key thing, really.
Yeah. What is that all central banks have on their own version of their own currency has for using, going to want to have
Twitter, and we're reading how many people outside of that rather small bubble crypto. Yeah. Is it becoming mainstream? That's another question entirely.
It's one that puzzles me because yeah, I don't see it becoming mainstream just yet. But you know, these things tend to creep up on you. Looking elsewhere, tech fright is now calming. Of course, everyone's looking at Jackson Hole. What do you make of the whole rotation? Real rotation to and other lesser, you know, love stocks out of tech, or do you think
Still just the froth this week. The losses have been heaviest in tech, where you have seen a bit of recoveries in Chinese markets. So that's leading the way. Thing has been in the Mag 7 and in AI because of these reports. Now, was the rotation going on before the MIT report and before Sam Altman's comments, or was it chicken and egg? But it's certainly the case that this week has seen that rotation, and that's healthy in ways. This is the end of the AI. We'll shift away from the time being from the US, which argue has gone too far too fast, and then you look at the yield for the index and thinking, oh, actually, value. And I'll put some money back to kind of movement rally just yet. We were NASDAQ in the space of 2 weeks since it bottomed at the beginning of and the Powell really the excuse that to continue to de-risk in the short term. But seasonality, if you look at what normally happens to the S&P in a post-election year, if it is going to weaken, then about now wouldn't be surprising. And so it would again, probably from early. So you could for a bit more of a downside in September. Maybe the August bounce gets wiped out entirely, and then we reassess over the next 6 weeks.
Of course, the other big thing that could rock markets, trader friends, is Nvidia's earnings, and that is out the day after my birthday.
Oh, is it your birthday next week? There you go.
Nice little treat. Just this is when I had been asked preview. When are we going to get the Nvidia preview? Well, if you type Nvidia, and Fabian, yep, she's one of our market analysts over it's Australia, isn't it, Chris?
Yeah, she's Australia emerging markets. Yeah.
And we've got a Nvidia preview there for you, written by her. What will be interesting, of course, will be the AI story, whether we're going to see more growth there, and that US-China deal will create more growth for Nvidia, or actually, are we going to see about how that chip is not as good, and China's hit back, saying happy with this, and
yes,
China's triggered this $4.5 billion charge. Yes.
Yes, the Lutnick comments.
Got away with words.
Oh,
right?
he's hopeless. They're just him now. But yeah, yeah, exactly. And it essentially saying that they've gone down like a lead balloon. position in China after all the excitement of the past 4 months, and then the US Commerce Secretary comes in and just knocks it all over again. So it intensifies China's already.
When you fly on the wall between
Exactly. Can you imagine? He will be absolutely furious, but not much he can do because Lutnick will be running to the White House for defense. But
to
it's
Orange
impressive,
Man.
really. Yeah, of course, this is some. This is a different world. From you have this kind of claim yourself a bigger slice of the pie rather than trying to grow the pie. Jensen and the poor old Jensen Huang getting his at the Commerce Secretary.
Yeah, of course, Jensen is very, very keen on, keeping China hooked on its chips. Is developing the Halo systems, and of course, its own chips that are designed humanoids. Lots of humanoids if we're going to go out, go forth into space, says Mars to different planets. Do that, I'm actually quite happy with Earth. That's my own view. But yeah, in terms of Nvidia, keep an eye out for what it says about tariffs, of course, and also that the US and to find out how this is going to impact growth in the future. Not just also look out for any confirmation of significant deals in Europe and the Middle East as well, because next you grow Nvidia.
Yeah, and you should look at, I think that the average move and result there has been about 5% over the last 5 or 6 results. We move historically much higher, but the average move is about 5%. I think the option from off the top of my head is about
talked about US and China already, but also incoming competition from Chinese-made chips as well. Price target there, as per the report, improving from 163 to 191 currently, and suggesting some 9% upside from current levels. So for those of you watching out next week, the biggie next week. Speaking of which, loads of people on the chat, Chris, asking about where you think markets are going to go next week. Do you think maybe we might see further upward momentum for the FTSE and the DAX?
Interesting, because it might be pushing on a string if you get the rotation sign to reverse. I don't know what he says today, I think. Powell's speech is the kind of thing everyone's just waiting for. You've got a long weekend in the UK. I think you've got likelihood of further upside for the FTSE 100 in the medium term. It's been I think if you're looking to the year end, yes, but if you in the next couple of weeks, maybe it's got a choppier time ahead of it. Will you get some dip buying finally coming in the US to try and lift this stuff off its recent, poor performance this week? Then that's entirely plausible. I think if you look at the S&P, you've had a defense of about 63 over the last 2 or 3 days. Maybe there'll be a floor if he comes out dovish. If you get a very hawkish Powell today, watch the dollar, watch that surge to the upside, because the positioning of the dollar is still quite heavily crowded to the short side. And that means I think if you're looking at something like euro dollar, maybe you've got potential for more weakness there. And then indices, signs of recovery. And it still feels like a very low volatility environment. Yes, I know there's the risk of tariffs, all this kind of thing. But you've had a bit of a week, but it still feels like, to be honest, the 2017, which was a very calm year, and you didn't have much of a sell-off. I think the average drop so far this year is still relatively contained, even if you include April. So it overall, I think you've maybe got further optimism for some more markets upside.
Right, lots of people on the chat. Shrimp Fred asking about location. Has Chris got a smoothing filter on? Looks like he is in his 20s today.
Well, that must be the new camera.
That said that. And then Shrimp Fred saying thought he was filming. We're gonna have Guess the Chart next. With two subscribers away from 1,500. So get one more subscriber. So come on, people. I want you to slam that like and subscribe button to get us to 1,500 after we get back from Guess the Chart.
Ladies and gentlemen, the market opens in 5, 4, 3, 2.
There's a chart on the screen, and it's looking real mean. A symmetrical wedge or a sideways machine. I've got my mouse, I've got my dreams, but I have no clue what this madness means. Is it crypto? Is it crude? Is it volatile or just rude? There's a wick on top and a tail below. Is it time to buy or let it go? Snap that trend line, check that zone, draw a fib from peak to bone. Everyone's got a different chart, but only one will steal your heart. Guess the chart. It's a game of risk and art, like a fortune teller's dart. Throw your guess and play your part. Producer Phil's in the corner grooving. He swears the 20 EMA is moving. Rich up while Ain shouts trap, then they both run off to draw a gap.
Hey, welcome back to Opening Bell with Chris and myself. Wow, what did you think of that tune, Chris?
I don't even know what it is. Who?
It's created by a song AI, and
Thought it might be. How
yes, and
depressing.
James Watson, one of our gallery people, and he has great fun after every show putting together songs for Guess the Chart.
Wow.
Yeah,
Okay.
and we have a winner. We have a winner of Guess the Chart. It is Hamish. Yes, again, Hamish is on fire. Yeah, for eBay, we've got 20 seconds to open. 10 seconds now. You ready on our digital bell buzzer, Chris?
Oh, and is someone give me a bell buzzer?
That we're looking at. 3, 2, 1. Ding, ding, ding. Here we go, trader friends. And it is looking at the risk of Friday at the moment ahead of Jackson. Let's movers for us now. This is the FTSE. Right, take us through the losers list, Chris.
So far, we've got Croda leading downside of 70 basis points, Sage Group as well, and the LSE down by 50 points. It's just contained. There were no RNSs of any note this morning, so there's not much to talk about on the downside. Group point off, right move 0.4%. Continental Hotels, another sort of heavy stock.
The gainers list there. Sausage up 3%. We've got BP as well, moving slightly higher, but BP Germany, yoga, you will here bright and early, right at the losers list first. Any of those names pop out to you? Commerzbank there down 1.5%.
It's replicated. Siemens as well, 0.9% in early trading.
Let's have just have a look as well. Total Energies 8%. Rheinmetall still recovering, licking its wounds there after falling. He spoke. Beaten down recently, also coming back slightly. So Mercedes, Porsche, Chris.
You have to zoom in for me. I can't see that. Airbus now 0.3 and S Micro again, another 0.3% drop. Move to the upside in early trade this morning. There's another bit of a divergence and more tough time. Let's not to be too cruel now.
Actually hasn't had a happy time recently. Let's see, losers list there. Airbus down 0.25% there, and we are also seeing the defense names a little lower. Safran, Dassault Systems as well, lower after Trump very vocally said he wanted more of the defense spend. Their hands ahead of AP.
I think so. I think that's definitely the way to view it. There wasn't very much in the way of news this morning. But it's for the bank holiday in the UK. Drivers, unfortunately, this morning. What were they? I didn't even see the numbers.
The retailers
from them. Retail sales for the UK.
No, that was a week.
Oh, I must have made the thought out of nowhere. So yes, you've got a Trump speech at 5 p.m. this afternoon, so that could be anything. And don't forget as well, Powell speaking, but tomorrow, which is in the morning their time, so about 5 p.m. our time, I think. And
Going to be dropped at just taking a look. Ahead of next week, which we will have tons of earnings. Big one being Nvidia. Results from, I believe, CrowdStrike, HP, Snowflake, Agilent Technologies as well. Tuesday, MongoDB is out with numbers. You heard Capital about that. This comes at a time when US stock indices, have seen a slight rotation from tech to some of the more unloved names. In August.
Still a bit of that's another strong performer, though, isn't it? I think there's a lot of money flowing back into there. If only. So that's a alternative tech trade that dominates everything else.
And oil is amongst the weakest. Right, we're going to wrap here because we've got Pete Ward coming up next to do fast markets with me. Thank you so much, Chris, and have a fabulous weekend. Of course, I'll be watching when JP starts speaking with you. And yeah, please do bomb me a message if you see anything funny happen before then.
Will do. Have a good weekend.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and prices across 17,000 markets, letting you find opportunity. So if you think the market's going up, you buy. If you think it's down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that we've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo. Open an account today, join the community, inspired to make moves.
Hello, I'm Axel Rudolph, Senior Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto. Trade live with IG.
Hey, Pete, how are you?
Hey, Ange. Yeah, I'm good. How are you doing?
Yeah, really good. Good to see you too. And so nice to have normally in the studio with online here. Feels a bit strange, doesn't it? Normally we're sat side by side.
Feel a bit distant.
So what is not distant is those Nvidia earnings that are coming up next week.
That's
saying
right,
that
yeah.
perhaps
So
just baked in that be careful. We might then see you know, disappointment or the numbers not coming strong enough, and then nothing happens to share falls slightly?
Well, I mean, the expectation, I think, is that growth. But the big issue, I suppose, or the big thing at the moment is that the news kind of might potentially be the export. Was originally halted back in April, and then they
Yes.
lifted that in August with some kind of deal. I think AMD and Nvidia basically come up with a deal whereby they'd share some of the revenue on the sales to China with the US government. I think 15% potentially. And yes, so basically overnight they put a halt on that. And it says here that they were ordered to halt H20 chip production. The information reported that
Need a lot of chips to make them AI enabled.
that's
It's also interesting that we've got you know, the story also from Boohoo. I saw this overnight. This is about the debt deal that you want to talk about.
Yeah, so this was a deal that came in yesterday. So it was effectively news that hit the market yesterday. And we saw recently, I mean, if you look at the stock price on Boohoo, it's just crazy. If you go back to, you know, daily, or even if you go out to monthly, we were up at like £4.50 or something, June of 2020. Obviously, a lot of capitulation since then. You know, different issues with their supply chains, various different. You know, large company again, but I mean, I mentioned it this morning just because it used to be a firm favorite among our traders who used to trade, you know, a retail basket of these THG, ASOS, ugly, basis kind of, you know, basis recent moves. So it'd be interesting to see if that is around and you start to see some growth. But yeah, it's not. It's certainly a very unloved.
To me, the stock short, especially after you know, that period as well. Isn't it?
It's changed. A brand, which
I mean,
did
when
have,
was the
you know,
last
a
time
big
anyone and it was like and then maybe?
No, I know. Yeah, it was. It's kind of all these, and now one basket. But I make yeah, and it was pretty popular as to paying the face of like 5 or 6 different sizes of the same thing and send it all back. So they were one of the first to kind of come in and try and do that. Kind of wasteful behaviour, I suppose. But yeah, no, yet to buck the trend, but we'll see. So we used to see a lot of business in.
Thinking it's going to buck the trend.
We do, and it's defined as a UK defensive, right? You know, a steady Eddie stock. But if we look at how it's behaved recently, you know, pretty impressive. Week or even just since Wednesday, and we've had FTSE move on from Wednesday to today 1.5%, so 140 points north. Indices or some of the US ones, it's really outperformed. And and we've huge push from 82 up to 8,800, and a lot of people scratching their heads, kind of wondering what was driving it, and the general UK names, and it feels similar again, where people are kind of, you know, the pace is the other names where they've had great growth, and they're going, right, okay, where's now a good place? Specific or do pay dividend. You look at BATS, and you look at United, got all those, and you know, since Wednesday, 4%, which is quite a large move of this size, especially in the UK market, where, you know, interesting days if Lloyd's. We've seen evident if you look at BATS or you look at United Utilities, and then you look at the FTSE chart, it's and so it'd be interesting to see if it
indices. Let's have a look.
From like, for example, maybe go on like a 4-hour. You'll see here. And again, you know, a bit of head scratching on with what's the world at the moment with the Powell. We're now hitting all time here. You know, get some dividend. The growth has been big, because you know, even still upon, and you look at the performance of the FTSE is still, you know, it's still percentage wise, it's still got more room to So yeah, no, it's interesting times. I
I
mean,
like
the one
it.
that's
I like it. Point that you're making, because you know, this does look back in itself, although the share price has been coming under increasing pressure this time. Vapes and of counterintuitive when you hear reports of tobacco maker working with regulators. You kind of sit up and go, what did you just say? And so they have been creamed weird flavors like rainbow, Candy Crush. Not that I know, but you know, this cookie butter, those, and and yet it is, you know, daily chart. And peers and everyone, you know, when that
week to this week, we dropped 24%, which is massive, you know, for a stock of this size. But you then have to look at it. Got a huge multiple. It was on an absolute rip. I think, you know, they had the numbers. It kicked higher, but if to $30, $60, myself to buy in it, and yeah, you got that's mine actually. The other day, I was having a look at 18. It's going to your initial investment out at least, and then run the rest, I suppose. Want to know, but that move in a perfectly, the speed at which it popped that high. So it's certainly one to watch. I was on to a client of mine yesterday. Very much the job out there. More money for defense, more money for drones, more money for all that sort of stuff. I don't fully buy into his $30-$40 metrics, but you know, that's what makes the market, Angie.
Yeah, that's what makes the market. Differing views. I've seen 40. Some 70. And so there is still, you know, on seeking alpha, because it potential signs to look out for sellers. Stock and next. What are you up to today?
Going to Norfolk for the long weekend for the bank holiday with another family, so that should be nice.
I'm
what about yourself?
Yeah. options, and also on line between and
I don't
I
think
got that right.
that line exists.
BBC. Have I got one place wrong? As you can tell, my UK geography is terrible.
Yeah.
Right. So Cornwall.
Yeah, that's a long way as well. But yeah, no,
It's a
typically,
long way, right?
to run Norfolk.
I'm going to leave you to it because we are going to have Bill Blaine coming up soon.
Cool.
Thanks so much,
All right,
Pete.
have a good one. Cheers, Angie. Thank you.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, fittest. Watch and learn. Cash returns, go. Hey guys, where are you going? You're not going to get...
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate 17,000 financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rises, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, from capital gains tax, but it's also commission free. Pay is the spread. With us, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you learn from. Educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, Join the conversation and be inspired to make moves.
Hey, welcome back, all of you. We've got the one Bill Blaine here from Winship Capital. Hey, Bill, how are you?
Good morning. I am just fine and dandy. Boo.
Ah, are you being on the boat or you're on now?
No, I've been away. That was a picture from the boat yesterday as we tried to get back to port. As always, working while I was sailing. And if you go to the video, which I'll admit is not brilliant now, that was taken from quite a distance. That is a worrying photo to me because that is one of the world's largest container ships. And about boats will say, hang on, it's half empty. Container ships should never be empty. They should always have, because they just into Southampton, one of the biggest container ports in the UK. Really, to the next photo, and that's another boat coming. Collapsed. It was very to get a container. Boats were empty. There was lots of people saying that negative consequences, one of which is going to be in story today is going to be Jerome Powell speaking conference in the US. And whatever he says, it's very difficult to argue that there is not going to be an inflation impulse in the US, and that's going to knock on it.
Is there definitely in your view that, there's they've got to soak up this inflationary push higher? Talked about lots of people, the higher income base, still have a lot. These people have yet to tap into.
Excellent word to use, fantastic word, because I was reading some research over the week, and it was talking about how a fantastic comment made by Torsten Slock, who is the chief economist of Apollo, one of the biggest funds. Certainly follow very, very. Now, Torsten Slock has made the I've had to start repaying them, and the delinquency rate has risen to 25%. That does not speak US consumer that has loads and loads of money to bear the costs of higher tariffs. So I do expect to see inflation remain significant. It's not going to be as devastating as people thought, but it's going to be a driver. And the key thing to think about there, inflation ongoing, it up with inflation in 10 years, 80% of what it would be worth today. What happens if suddenly there's a buyer's short end? Inflation is very, not only for
Hiltons, the Hyatts, that good, and demand is quite strong so far, especially from the higher premium end.
thing, because one of there are the same number, and some of the places here where these are beautiful villages on the coast. They were less busy sailing along the south coast. Things are holding up better is not suddenly bite. Tariffs were is going to take time. So, but soaking is going to be a new phrase. Because the inventory is still all there, And there was a second build up once we saw the agreement and Z through Besant to strike the tariffs. Indications are all that see an inflationary effect, and we are going to see ongoing in the English Channel. That about just how dislocated the whole global massive dislocation in global trade. Now, putting that in context of today's market means it's another fact to think about. Two things there. Added then put his own nominee in place, starts to get him close to having his own majority on the Fed. Actually, yeah, that we go into is that going on a US market, which watching it last
Yeah, JP does committee that is Trumpian either way, right?
that is going to happen. That is effectively, as I was going to say something rude there, is his plans and requests as European leaders were.
Now, you know, the stuff that you're talking about, Bill, on nothing really changed for the Americans, and it's actually out of the US. Wealthy, you know, older Americans, a lot of the money is in stocks and their, and so when it comes to that, has changed really.
You're absolutely right.
The price higher, but if they recently we saw this really markets even after the April tariff had
stunned us all with that have savings. It is certainly by the strength of the stock market because they feel rich. Cruise or they fly to you, tell us how wonderful their president spending. That is only a tiny little part of the US economy, and it's the rest of that we need to think about because opportunity are just struggling. And so the whole debate about inequality massively the financial crisis as a result of quantitative easing and the that look at it. And so if you invested in 2008, you were getting a low interest, more attractive compared to the very low rates in the bond market. As the bond, one of the if we in the artistic, but if the bond market resignations, one starts to see, and you're concerned about the market, I think
the average American again. These there's lots of up or delaying that or to happen as when it
institutional sector of the US from to buy. And it's only recently, it was fascinating price. That's one where anyone's made any text. I'm still thinking there's, because I reckon but all the other tech stocks holding bubble that we've seen while I think you 3 weeks ago the clear top Facebook play folk in the world today. And this actually we're going to hold back any further spending and we're going to look at our whole AI again. So and on a massive salary. So something about the top there. And look at companies like Palantir here. Going to not announcing fantastic AI product you can try and use. Actually look at data and use it. Change the world themselves.
software can deal with any sort of data. I've either find it Google themselves have also said they're really worried about their existence with all this AI software coming into play. Our viewers of where we might, of course, that swan song, if you like, the final stand. What will he say? Well, too long, because that is coming up in a couple of years. And also, we've got lots of talk about whether or not we're seeing this. Early to say yet, but we did see a rise in consumer-facing many energy stocks in the previous session, defense stocks pressure in a week of
I found myself too. The whole thing, the meeting in Alaska, and in terms of their flattery of the US president, and where quite clear that it's absolutely not. It's clear that Trump has been unable to move forward. So, well, I think is something that's very significant for markets. It's clear is American. And we can then give that a much better idea if Europe just properly and starts up, man up, country up, that behind or what Russia. Russia is the day Russia enormous bonus services, and yes, they are learning and they're fighting. Eventually, they will do the Russian thing. And be because the European economy per GDP is less than half, and Ukraine up way that you're going to resolve this, but I think Alaska meeting is
which is not uncommon to talk the talk and not to conclusions or to hope so much for a deal until these things. That was on this show. Lots of people chiming in. On a person saying investors are beginning as what we talk about a lot here. capex has got to slow or start petering off?
And yeah, there's I think that's a fascinating point about it. The dot-com crash, and have then seen multiple renaming itself businesses, and they just haven't happened. They all change everything that we do, but an awful lot is. And as soon as you start demanding that, is substantial. It is losers because they just have.
Seen as being behind the curve.
I wonder if the curve is somewhere.
What is it they say? The where the early worm gets.
But the peak.
One, because my view is that Apple will still be a very large player. Perhaps, you know, one is has been making real money in the sector rather than just the revenue streams are going to come across Europe sessions, but it is very for the CAC and also the FTSE are all flat there, and if the momentum continues, we could be looking at a weekly rise for the 100 of around. Also, actionable movers. Maker of Dulux, so painting. I know Maturin is looking at utilizing Dulux paint there, and many of the banks there. We checked on this earlier, was up 3%. It's up now by 3.6%, and Standard Chartered. This move coming after the bank said it was a favorable ruling by the US DOJ in a long-running case. It had a favorable ruling. So yeah, let's head to the break, and we'll be back. Of all sectors. Hey, welcome to all sessions, and we are now off to the races. Let's have a look at how it's shaping up here. And as you saw across Europe, let's have a look at some. First, we have Lucid down almost 3% there. Nvidia is down 1.6% as well. All this report surrounding the H20. Like the AI and the tech names not having such a good day ahead of that Jay Powell speech in Paul on that short. It's down almost a as half a cent. Let's have a crossover. Neo is the premium made by the Chinese, and it is very, very volatile. So I will continue to check in on that on as it's down 4.7% at the moment. Pinduoduo, another Chinese name, down 1.9, actually down 2%, let's call it. And Virgin Galactic, 1.2%, PDD up almost 2% there. Novo Nordisk, interesting stuff there. We are seeing coming back there after a pretty tough week, perhaps underlining trends and products that work. So all the talk of patents and pills destroying his business. Seeing lots of contenders having issues trying to get through. Strategy is up 3/4. We also have Beyond Meat up 0.5% there. It's often on the it's another extreme volatile stock. Starbucks growth 3%. That's from 0%. We also have some of Novo Nordisk price from to 6 and all sessions there. Do keep an eye on all of our updates on the IG Twitter page, my Twitter page, where I'll be giving you the link, hopefully from JP when he starts. Also, a reminder for those of you, thank you very much for slamming the button, because we at 1.5. Up after
Retail's taken a bigger share of one of the trading desks I speak to. If they get it wrong and change their mind, click. They can take health. Big design. Don't like that. Can change their mind and exit quickly. You usually can't do that.
Or has seasonality.
Seasonality, which often sees a correction through there, so it could still happen. But what we don't normally have is a 20% decline in the S&P from so the earnings season we've just been through was set so low after April, and everybody's saying, can't give guidance. So
Taking a look at the US 500, the S&P 500.
Technical trading says that. Very thin out there, August traditionally. Interesting percent to the market than I think it has done for some time.
You know, what happens in a market when retail coming in, we're trying to find, especially for us, because Julian, please get this for our trade friends here. All the in the US, you might as well right on their apps. Passive investing is growing.
Growing for decades. I mean, literally 2 decades. Passive investors probably.
And where is this figure that's 20%?
You can only put that amount of money in places like Robinhood, places like these retail accounts. Means going to be. Let's take share, according to one of the trading desks I speak to. Represent the volume. That's the.
To sit on it.
Well, not only do they can sit on it, but line, right? Wrong mind. And you United Health. They are fearless.
Navigate a market. Is out of the window. Trump tweeting left, right, and center.
Trump has made this by day. Problem is that he's a bit like a little boy. Jesus out of it. That's nonsense. Now, he could turn around and all commentators have his favorite. So he could, well, I've been so stupid, you know, and is it playing to his political support? Yes. The whole will be down the line.
Neil, I mean, here. Answer Andrew, so I know you can talk. The US market.
Short stocks. I see he's picked up Palantir. But it's also doing incredibly well. And I would say, no, I'm definitely not shorting Palantir. The same question. Tesla was crazily, stupidly over. Pointed, they put up better. Goes higher.
And
it's a big. Tesla's not going to be shaken out. There are much better things to short.
Yeah.
But I do short, yeah.
Household name now.
But why short world leaders? There are really a lot of bad companies out there to short.
It's still good. Like another one, like another Cloudflare.
Oh yes. Okay. So Cloudflare, valuation metric is incredibly cheap. It trades for. Google, Cloudflare is number 4. But significantly, it was engineered and architected differently. Without going into too much detail, it's a more efficient mousetrap. It does compute, it's infrastructure, it's storage, but it's just more efficient. If you consider that Microsoft now said 25 billion worth of cloud is too. All they have to start doing is taking share, and they don't have to win business from Amazon or Microsoft. They just take a piece of it, of a massively growing market. I see a lot higher. Oh, what's more, at 70 billion, it's one of the largest companies not in the S&P.
I see.
But we don't, I'm not saying buy it for that reason, but it's a great company, great company.
The other space that I really like, GLP, no hit recently because of, competition, and also talked about, having to cut costs. We've got all these, pill had the pill version years and years and years ago, but they don't really need it as a nation, do they? But Novo and Eli, very interesting to me because I have both.
Okay. They will like, what have you done for me lately? What that means in the door own and have told clients to buy, which has had a huge move on the back of this Lilly
therapeutics. Yes.
VKTX. It is, now look, this is harem scarum stuff, but you can see basically that move in the last week was from the day Lilly announced that its drug hadn't done so well. So that's a move from 30. We've had a 20% move in the last week. Now, like all biotechs, this company is burning money like crazy. But if they're in phase 3, this P1, if it works, that company won't be around for long. So the trouble with CoreWeave is it's owned by Nvidia. It makes loans to Nvidia. It's almost like a channel for Nvidia. I don't get CoreWeave. Now, went to 150. As in, my machine said, you can't short this stock. When something can't be shorted, that means probably too many people are short. If people are short, you don't want to be. I don't fundamentally see why I want to own CoreWeave. There are some fairly other hairy, scary stocks that are slightly transparent.
Yes. And if you could effectively a player in it might as well be Nvidia.
Well, Nvidia is not expensive. I mean, it really isn't expensive. It's much more. You've got to remember, the Nvidia's done pretty much nothing for the last 14 months. And it got to 150 last July, and we're at 80 today. You know, in stock terms, that's really not a lot.
And I don't think it's expensive, given they've gone from talking about petaflops to exflops. So
I mean, you know, that the AI train is.
Yes.
The gating factor, if anything, you mentioned energy, will be power.
Yes.
Right? If there is a disaster out there, it's that the electricity demand a choke point.
That is my week as well, with slight, almost like the start of Julian, this rotation back into, you know, consumer discretionary.
That's right.
Right, from tech. Is this going to be a good time? You know, with Amazon.
Well, I do have issues with Amazon. I think they announced yesterday they're now going to do home delivery, have delivery, same day delivery. Well, obviously, the market initially went, that's good, and they took Amazon up a little bit yesterday. What they really did was they smashed the competitors. So Kroger went down a lot. The ones that really got hit were the, which frankly is the business that I think is pretty, you know, afraid to say. So Instacart, DoorDash, Uber, you know, Uber, obviously Uber's wider, got a bigger set, but so Instacart got. If Amazon's going to do home deliveries, that's going to cost. It's not good for UPS either. It's not good for FedEx. It's going to be more of delivery. So, a big change. You know, these are my instant, because it was only announced yesterday. But Amazon is losing share in the cloud business. The numbers this quarter than Amazon did. And Walmart's back in retail. We'll get more from Walmart. Because what we've had is the tech earnings are great. Walmart will give us more of a clue about the consumer next week.
Fantastic. And just taking a look at Walmart as well to see whether there was a reaction Amazon news. The reason why I'm interested is because when I to go to all these places, I never buy anything. I'm just stood there watching. I know it sounds strange, right? Maybe trainers are a pair of trainers that I picked. I always pick up about 3 pairs because it's just right.
Yep.
Your targets, your
Used to be.
Used
Getting
to
better now. Oh, God, so now 135.
It's cheap there. But you know what's
There's
interesting?
Walmart yesterday, that red bar.
Yeah, and that makes sense because have you heard about their premium delivery services? I can't imagine anything more than I thought. You pay an amount for them to put it, well, bring it to your house. Garage there. Then there's an expensive option into your house. And so they sit in your garden or
Well,
just drop it.
drone will arrive. You'll hover above. This can be in, you know, slightly rural, where everyone has a yard or garden, whatever. So the thing won't go in your house, but it won't have to. But it will be able to leave it. It'll sort of come down. The drone will hover above the garden, and then it will just come down on like a little parachute. Drop it down, and then you'll be there to take it. And if you're not there to take it, it'll just drop the thing.
Inside Day. What will Powell bring tomorrow? It is Thursday, August 21st, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan, taking through the rest of this hour. Futures market closes at 5 Eastern, 4 Central. So if you're on the platform Tasty Trade on the website tastylive.com, welcome. Thanks for joining us. Come to the chat. Tell us what you're trading, how you're preparing for Powell's speech tomorrow. He speaks at 10 a.m. Eastern is when the remarks will be released. Of course, today we have a little bit more of that jiggle lower in tech stocks. More warnings, Meta freezing their AI hiring, on top of Sam Altman's warning, on top of the MIT study earlier this week. But the big news is that Fed cut odds continue to decline ahead of tomorrow. What was a 100% shot of a September rate cut, according to the futures market, now residing closer to 73% last time I checked. So we're not going in head over heels expecting that policy is going to be loosened. PMIs today a little bit warmer. What does that mean for bonds? Bonds trade up following those cut odds, moving lower. Dollar bounces back. Oil higher. Very cryptic Truth Social post from President Trump comparing himself to Richard Nixon staring down his Soviet adversaries.
Oh,
maybe the Ukraine war is going to take a different tack than a peace summit in Alaska may have hinted at. Either way, though, Dylan, you were on Hear Me Out earlier. You say nothing could take down this market. The market's been taken down this week. Is this just
has it been taken down, or has it just been moderate? I mean, now we're getting into semantics. When I say, you're going to call this a take. What's the?
I was going to say, is this like a Monty Python, just a flesh wound, or
this is a 7-year-old with a knee scrape off of the seesaw? Get back out there, kid. Brush it off. You're fine. Just relax. We should be so lucky to get it taken down so that we can pick up a bunch of AI names. I mean, I think that, listen, 1, this is not a takedown. 2, this could be foreshadowing of a takedown, right? Like takedown sometimes, we may look back at this in a few weeks and be like, ever since Sam Altman, sort of threw a little ice water on the AI thing, and then Powell came out and threw a little ice water on the Fed rate cut expectations, things got real squirrely. But I would say it's too early to say that at this point. I would say this is just a very tempered pullback of positioning, rationally so, in advance of Powell, who could reduce rate cut expectations further through the tea leaves tomorrow. And for sure, the Altman AI stuff, I mean, because the market is where it is exclusively, in my opinion, not exclusively, but largely because of mega optimism about the technology piece of this, and to the degree to which there's any tempering of that, everything else has to come back a bit.
Ilya?
It all makes sense to me, I guess I would say, but I wouldn't say that it is an indication of any consequential shift in overall expectations.
Ilya,
I would generally agree. I mean, the positioning isn't catastrophic. We've been talking about the level to look at in the S&P. This is not a confirmed top. We're not there yet. We're down a little. If we compare this to the pullback that we had in late July, that pullback was about, what, 3.5% peak to trough. We've now had a pullback peak to trough of 2.25%. So this is not like a scary, holy moly, we're going to have a big sell-off like February to April kind of thing yet. I don't think that that's off the table by any stretch, but that's not what this is right now.
When does it become that?
For me, the line in the sand is about 62.40, 62.50 on the S&P. That's basically lining up with the lows on August 1st. I think there's a kind of horizontal shelf there, going back to even early July. So, like, if you put a horizontal line at the July 7 low, I think you basically see it. And that's, I mean, you and I have, I think, the same line. I think that's the line in the sand. That's where you would have rounded off a top. And then you have something bigger.
You know, you mentioned the PMIs this morning. Those didn't cause a problem. In fact, they moved in quite the opposite direction. They beat expectations roundly.
They beat expectations,
PMI,
and overnight, by the way, Australia beat expectations, Japan beat expectations, the UK beat expectations, the Eurozone numbers beat expectations. All of the PMI roundup, not just the US, all of it was a little bit soggier on services, a little bit better on manufacturing, overall composites higher than expected across all of it.
Yep, Dylan, manufacturing 39-month high. Chris Williamson, who's the chief economist there, points out that the PMIs right now are pointing to a 2.5% annualized growth rate, up from the 1.3 expansion rate seen over the first 2 quarters of the year. If we're not getting a recession, doesn't that buttress your argument that there's really no reason to be so concerned about what's happening with Powell's speech? If it's a dip, it's an opportunity to buy.
I mean, yes. I mean, that's why I've sort of maintained my Mike Butler-based optimistic sort of worldview. I don't see evidence of a meaningful economic slowdown. I don't see evidence of a big negative economic event. I just see sort of hand-wringing about economic data churn. And for sure, I'm actually more concerned about inflation, because for me, I don't understand how you can raise the price of all imported goods by 10 to 15% and not have that make a permanent influence on pricing. Like, how is the cost of everything not higher? How is inflation transient when the overall cost of transacting has been increased on such a fundamental level? That's actually my biggest economic concern, or concern about the economy, I guess I would say, is in that regard.
Can I point out what's
together?
Can I point out what the economist of the PMI report says here? companies have consequently passed tariff-related cost increases through to customers in increasing numbers, indicating that inflation pressures are now at their highest for 3 years. The resulting rise in selling prices for goods and services suggests that consumer price inflation will rise further above the Fed's 2% target in the coming months. Indeed, the combined with the upturn in business activity and hiring, the rise in prices signaled by the survey puts the PMI data more into rate hiking rather than rate cutting territory, according to the historical relationship between these economic indicators and FOMC policy changes. So, Dylan, we talk about running this thing hot. Deficits are up. The inflation data are at a point where the Fed would not be considered cutting, but for the fact that the composition of the Fed board's changing, and there's a great deal of political pressure given some of the top lines. Now, I would make the cogent argument that what's happening in housing, in jobless claims being at a 3-month high, in continuing claims having risen to their highest level since November 2021, with basically the southern portion of the US geographically experiencing a falling out in the housing market, you could cut. There are reasons to cut.
What would be your top 3 reasons to cut?
Housing.
You're a member of the board of governors and you're advocating a cut in September and you're in the boardroom. What make your case?
Housing, jobs, and then broadly speaking, labor market composition.
So
because of
you're saying a little bit of a mushy labor market and the overweighting your whole the disproportionate healthcare role in the labor mix.
Well, this is the graph that we showed yesterday, Dylan, right?
Mm-hmm.
Healthcare, right? Healthcare has added 55,000 jobs in the most recent month. Over the past 3 months, healthcare itself has added 150,000 jobs.
Mm-hmm.
When you drill down, it's really healthcare is what's driving social assistance, healthcare. These are very low productivity industries,
mm-hmm.
right? These are important industries. We don't want people dying or suffering, but in terms of where the job growth is right now, they're not in the highly productive areas of the economy. So knowing that, seeing that claims are up, I know a lot of the claims are being driven by what's happening in the DMV area following the federal government trimming, and Maryland, Virginia, Delaware, right? You're seeing those are the states that are providing the bulk of the jobless increases right now. But I would argue this. I would argue that we don't have jobs growth in the meaningful areas of the economy that matter all that much. Not in professional business services, manufacturing net down, wholesale trade, retail trade is barely up, but transportation, I mean, forget government cuts. So what? That's nothing here. It's moving in the wrong direction. So I'd point to that. I would point to the fact that the housing market's in a really bad spot for most of the country. Those would be my 2 prime reasons. And I look at the immigration.
And then why are you? And then what's your count? And then I would say to you, well, I understand your point, counselor, but the labor market is relatively fine. There's no big evidence there. And we have we have substantial inflationary pressures, the consequences of which we do not yet know because of the administration tariffs. And shouldn't we be cautious before making money cheaper at a time when inflation is already sort of on the threatening to emerge as yet another consequential issue, especially as we go into 2026 and as these tariffs get implemented across the board? Maybe we should take a little bit more of a wait and see attitude before we go around making money cheaper. Good sir.
Yeah, no, I think that you could make that argument too. I'm not denying that. You could really go this both ways. What do you care more about? Do you think that inflation is transitory? If you do, and you think that's the likely outcome here, then you're looking at the labor market and you're looking at the housing market a little bit more heavily in your weighting. And if you don't think inflation is transitory, then you say housing market and labor market weakness or jitters be damned. We can't cut rates when inflation's pointing up because this isn't going to be transitory. So pick your poison. What's better for the stock market or the bond market?
This is where you
Break
have
the tie, Ilya.
This is where you currently have the Fed where it is. And let's sort of re-anchor ourselves in what the Fed itself is saying. The Fed is saying that there's been a slowdown. So that the economy is slowing is not a controversial thing. The PMIs here from S&P, they're optimistic. These numbers have skewed optimistic. ISM numbers for this same period, we don't have them for August, but in July, we had very strong S&P Global numbers, and the ISM numbers were awful. They put the economy at standstill for the same period. So there's some...
You say the same period? You know what this reminds me of? Look where the PMIs here on the chart. This is for the composite output. You think about late 21, 22.
Yeah.
And then you go where the inflation numbers are, pointing up in 21, right? Think about composite PMI output here next to CPI.
Yeah.
This is like, are we going back into the vibe session?
Well, so this is where it gets...
This is where we just muddle through and things feel shitty?
This is where...
Doesn't that feel like we're going?
But I'm saying this is where it gets interesting, right? The market reaction today, if you open the S&P 500, you put it on a 15-minute chart, and you put your cursor on the PMI release, the markets are telling you what they think of it. They don't like it. That surge you get, that's after. That's the PMI release. The markets then even out because the event risk is out of the way, and then you basically settle exactly where the PMI landed you. You sell off all the way into the PMI. The PMI is the crescendo. The markets then kind of seesaw as the event risk comes off the board. Everybody takes their speculative bets that maybe they had on the PMI off or put them on or whatever it is, and now we're looking at Powell. But the smooth trajectory this morning of saying markets open, they open down, they trade down all the way into the PMI comes out, it's better. The market says good news is bad news. And then everything essentially gets choppy and settles into the close as everybody
10 o'clock we had
figures it
existing
out.
home sales. Existing home sales beat today, which was a nice little development. But after they
That
beat,
didn't save any, and that didn't save anybody.
No, but I think right now, just watching this at the margins, right? We're still holding on to some good news is good news kind of situation, right? We really don't want the economy to confirm the belief that we're teetering into recession and therefore the rate cuts are necessary for such a reason.
No, but the markets clearly seem to think that.
Yeah, but it's a different setup, right?
I mean, here's the upshot.
What's the upshot?
That I thought was the most kind of pointed for me. We went down to 42 basis points for this year, but we went up to 72 basis points for next year. So the markets looked at everything that came out today and said, this means the Fed is going to do less now, maybe even less than they were saying in December and March and June, which was all 50 basis points. Now, okay, maybe not the full 50, though the markets are still leaning there. But they've taken certainty in 50 off the board. But next year, we're out to almost full certainty of 3, and the Fed is still at 1. So the markets want these cuts. They want them because they've been looking through this inflation for months now and saying the problem is actually disinflation because the tariffs. And once the tariffs work their way into the economy, they're going to be more a disinflationary force because they're going to hurt growth than they are going to be an inflationary force because there is a one-time lift in prices that then goes into expectations. The expectations extrapolate. This is the thing the Fed is concerned about. That basically what could be a one-off adjustment is going to become a lasting adjustment because if you don't do anything about that adjustment, then people are going to say, oh, well, then prices are going to rise like this going forward and forward and forward and forward and modulate their consumption accordingly and modulate their investment accordingly. And then the inflation gets stuck in expectations. And then it's impossible to get it out, but with more tightening at great pain, as we learned in 2022. So when you read the FOMC minutes and you go, they're worried about asset valuations. They're worried that the weakness in the labor market isn't real, that it's just immigration and not job losses as such. That nobody's firing anybody per se. They're just not hiring because there's no one to hire. Because immigration. The tone of all of this is very wait and see, but the markets want their cuts. That tells you the markets see through this near term back and forth and are looking further downwind. So this to me makes the September rate cut kind of a whatever situation, unless, of course, it doesn't happen for some reason, in which case I think everybody is going to freak out. I think the object of speculation isn't that. The object of speculation is what happens next year. And the markets want 3, and the Fed is giving them 1. That makes the SCP in September, the Summary of Economic Projections, the real mover. The Fed is either going to line up with the markets or closer to the markets, or it isn't. And what we, I think, are listening then for when Powell speaks tomorrow is some sense that more urgency about the business cycle has materialized. In June, they said, okay, maybe uncertainty is diminishing. In July, that they took it back and said, no, it's not diminishing. Everything is uncertain. Everything is still very rocky. We don't know. In September, it'll be, well, has the uncertainty diminished? Do you have a better sense of what you need to do? Are you paying attention? And if the sense is kind of vague, and I think Dylan is right, Powell's going to say nothing. He's going to do the same song and dance. In the immortal words of one Curtis Jackson, the same old two-step. And the markets aren't going to like it because it won't endorse their 3 cuts for 2026. And that'll be the story.
While we're still on this topic, Dylan, I just want to point out that Powell's speech is a reaction to, or at least in reference to, what the key theme of Jackson Hole is this particular August. Jackson Hole's theme this year is labor markets in transition, demographics, productivity, and macroeconomic policy. That sounds like it seems like if Powell is going to be making any comments that are in line with the theme this year, the stage is at least set as a backdrop. This backdrop is not inflation. The backdrop is not changing the Fed's framework around inflation in an era of north of 2% inflation, right? He's not going to be rolling out a 3% inflation target tomorrow. The real focus is on labor. I couldn't help but notice that one of these preview articles I was reading, it said tariffs and an immigration crackdown have slowed the economy, grinding down job growth and threatening to increase unemployment. 2 members of the 12-person committee that votes on monetary policy have already called for lower rates, and financial markets are betting a rate cut is coming. What is more important long term? Does the Fed care more about inflation or the labor market? Do you think, given everything that we've seen post-global financial crisis or COVID, and more importantly, does any of that matter once Powell's out of office and we have Trump's appointed Fed chair?
Are you asking me?
Dylan, first.
I think inflation is the number one thing. So I think once Powell's out of office and I think inflation is the number one thing. I think that became clear coming out of COVID. I think that the fact that Trump's going to appoint a lackey to be the next Fed chief will only make inflation fears much worse. Because if in fact Trump is successful in appointing someone who is indifferent to economic reality and operates in the same way that the rest of his cabinet operates, I'm thinking about Pete Hegseth, I think that putting someone in charge of the Federal Reserve who's willing to just do what the president says, no matter what the economic data is going to be an inflation catastrophe, which might be Trump's legacy, is total annihilation of the US dollar through catastrophic economic policy, which I'm hopeful doesn't happen. But I actually think that the idea of that inflation is the number one concern in the short and intermediate term. And the idea that Trump is going to implement a loyalist who will do whatever Trump texts him to do with interest rates is going to be really, really bad for inflation and ultimately drive bonds much lower and rates higher. Even though they're going to cut rates and the market rates will go up, and it's going to make them insane.
And make him go insane. Okay, so Dylan, let's just what are the odds? I don't think that Trump's firing Powell, but just game this out. There has to be some odds where Powell doesn't come out and tell Trump what he wants to hear, and Powell is summarily separated from his employment at the Fed. If Trump's going to rage fire Powell, is it tomorrow or is it when he doesn't officially cut rates in September?
Is what going to happen?
Let's say Trump's going to fire Powell at some point. Just game this out.
Throws a hissy fit, let's say.
If Powell comes out tomorrow and says no rate cut in September, does Trump try to remove him before the September meeting so rates can get cut? Or does he?
No.
So what's the play here? Does he appoint a shadow Fed chair? Does he announce Powell? What does he do if she doesn't get those cuts? That's my sense, because I'm thinking about Fed independence here is a theme likewise of this Fed meeting, if we want to admit it or not.
I don't think Trump's going to get mixed up with Fed independence. I think that, I guess a lot of people have lost a lot of money betting against the excessive lengths that Trump will ultimately go to, but I just don't see where he's going to actually do that. Like, let's assume, first of all, Powell's going to cut rates. So this is going to be a non-issue, in my opinion. Second of all, if Powell doesn't cut rates, there'll be lots of rhetoric. Oh, the man's an idiot. The man's a fool. The man's, all sort of negative commentary. But I do not believe there'll be any action of consequence on that. I think that there's just a plan to appoint. Again, it doesn't matter who the Fed chairman is. What matters is the actual economic reality. Like, the Federal Reserve is not just some random group of people that are doing whatever they want. They may be doing a bad job at times, but they're doing the best job that they can to interpret the economic data that's in front of them in the way that to the best of their ability to try to manage for currency stability, inflation stability, growth, and labor market stability. I mean, this is their mandate. And that's not going to change. And in other words, if you were to change the administrative culture of the Federal Reserve and detach it from economic reality, the bond market will put an end to that super fast. And that I just don't. I'm even with the most loyal. Even if Trump made himself the chairman of the Federal Reserve, I believe that the bond market would temper his ability to do anything, because I don't believe Trump wants to supervise a bond and currency catastrophe. So I don't think it matters as much as people. My point is, I don't think it matters as much as as we might think.
Ilya, is this a discussion like akin to me as a New Yorker considering buying volcano insurance?
I mean, so they want
waste of time, money.
They want to talk at Jackson Hole about labor markets and demographics, right? What are they saying? What is this a conversation about? Is it really a conversation just about labor markets? Of course it isn't. Because what are we talking about? This is the oldest conversation now, right? Chris, you and I were screaming at the top of our lungs in 2021. What are we saying inflation is transitory?
Oh, I got to be intellectually honest. I was not in that camp initially. I was very much in this is transitory, it's supply chain driven, which it was.
It was, but not in full.
Not in full. No. So I wouldn't say that I was fully right. I was late to that party, but I was also
yelling. I was yelling from the rooftops, if you recall.
But my disconnect was at least I was
inflation reasons.
I was at least going into that year, like thinking that the Fed was raising rates. I didn't think inflation would run that far, but I was long energy, which got the tail end of the Russia-Ukraine war. And I was short tech stocks, like heavily short ARK. So it was real for me, at least. I wasn't right, but I had the right trades on. So it wasn't terrible, even though I finally came around to, okay, 9% inflation, maybe not so transitory, a little too late.
For me, it was very, very obvious that there was the supply chain disruption, and that was one thing. But that also, there was a demographic change that started in 2017 and was very much accelerated by COVID, which was the leaving of baby boomers from the labor market, the mass retiring, just because people got of age, of the biggest cohort demographically in the labor market. And that also both sides of the political spectrum, as evidenced by the 2016 victory for Trump, the way that Bernie Sanders did so well, that both sides of the spectrum, the way that Biden was governing and didn't take away many of the tariffs, that globalization had become a bad thing on both sides of the political spectrum, no matter how stupid that is. That it lost favor. And that people lost sight of the idea that the problem with globalization isn't globalization. It's the handling of it and its smaller side effects for a minority of people by callous politicians. And that what would happen then structurally is there would be deglobalization at the same time that the labor market would get much tighter. And that what this would do is it would increase inflation structurally. That everything would become more expensive because the cost of doing business in a deglobalized world is more expensive. And because there is a labor shortage, because fewer people are there, because the generations following the baby boomers are just smaller. And there's not that many people to take on those jobs. So all of this was inflationary before COVID. It was a slow-moving ball before COVID. COVID made it a very fast-rolling ball. And so it was very obvious to me then already that the Fed needed to go on a massive rate hike cycle to put this thing back in the box. They did, and it worked for the most part. Those structural issues have not gone away whatsoever. None of that changes with tariffs or no tariffs, pandemic or no pandemic. All those things continue. Those are long-term forces. So when the Fed is going to go talk about the demographics of the labor market, they're talking about inflation. When the Fed is going to go talk about all of these things, they're talking about inflation. And if the speech that Powell gives is going to be, look at these long-term forces, they're inflationary. We've been talking over here at the Fed for years about maybe the neutral rate is higher. That is the point where incremental jobs growth is going to be inflationary if only it's one more job, the kind of neutral, maximum employment with price stability. That whatever that interest rate is now structurally higher and will be structurally higher because the world is different. The demographics of labor are different. The global architecture for commerce is different. That's a speech that says, yeah, okay, maybe we'll give you some rate cuts right now since you're all so hopped up on them. But if you're expecting a big easing cycle, there's a bridge I have to sell you. And because the market is so focused on not this year, not these cuts, but next year's cuts, and the cuts after that. And because there is a deep disconnect to the tune of about 50 basis points between the Fed and the market on this score, then the market is wrong-footed. And we see from the price action today, they want those cuts.
We did have earnings results come out for Intuit. They own the lovely company Credit Karma, if you didn't know that. Total revenues beat, but not as much as expected. EPS was up. Guidance looks good. The stock is getting pummeled here after hours regardless, minus 6%. Credit Karma lagging in the revenues. They're citing higher costs for labor and other input for anything they're doing, which is the theme here, because when you put 10 or 15% tariffs on things, things cost more in general. Dylan, in this world of everything pulling back here that's related to tech, that includes our beloved Bitcoin here. I say our beloved because I know how much you and Ilya enjoy it. I'm just merely a spectator. You guys are the true aficionados, our little
We're the real crypto believers.
My little Satoshis, as I like to call you guys endearingly. Oh, Satoshis. This is the lowest it's been since
Dylan
early
and I
July.
Are starting a band with that name. I don't know if you knew.
And we're going to issue a meme coin based on
That's
the
right.
band.
That's right. You can only buy tickets with the coin. It's going to be a great
you need little
pyramid
Satoshi
scheme. We're going to make
see
a
little
gazillion
Satoshi
dollars.
form. Yeah.
Come see the little Satoshis. Okay. 112,000 here, down 2% nearly today. Is this the end of the bull run? I can't help but notice we're starting to lose the uptrend here from the April lows. It's not feeling too hot this week.
Well, let me ask you a question, Mr. Question. What dictates the price of Bitcoin? What are the top 3 variables that dictate the price?
Sure that there's 3.
When your idiot neighbor makes more money than you. So jealousy.
No. So I think
greed,
that's the one.
Avarice.
I think that's the one, but I think there's only one.
Distrust.
In other words, you asked me, you're like, how do I have a real opinion on the price action of Bitcoin when I don't really understand why Bitcoin has any value at all, let alone why its price should be higher or lower, other than I'm jealous because other people made money in it, and now I'm going to do it because I want to make money in it. And you know, I mean, there was a moment where there was a lot of rhetoric of this blockchain rhetoric a couple of years ago, and the applications of record keeping and cross-border transactions and verification, validation, transparency, all the all that.
Smart contracts.
Smart contracts. You can sell, the whole title transfer, sort of all asset transfer will be all record keeping for all assets is going to be on the blockchain. Okay. And that's
I mean, RFK Jr. was saying he wants to put the federal budget on the blockchain, whatever that even means.
Exactly. But I don't hear that so much anymore. So I just what is the basis of the value of Bitcoin, Mr. Vecchio?
What's the basis of the value of anything?
Well, the base kind of the value of equity is a discounted cash flow of the future earnings and enterprise value of an ongoing business concern that sells a product or a service. The value of a bond is a discount.
Well, is that true? Palantir has a 200 price to sales ratio right now.
Yeah,
Amazon doesn't have that.
Very optimistic. Well, the short-term speculative forces are what they are. I mean, our good friend that we maybe don't know directly, Burt Malkiel, would tell you that even though he wrote the book A Random Walk Down Wall Street, he would tell you, even he would tell you, shorter term there is speculative fuzz. That's why you don't try to guess.
Because just fundamentally as traders, we are to understand that Burt and Malkiel's view on markets is idiotic. Because if it's just a random walk, then what are we doing here?
Even Burt Malkiel would tell you that he doesn't fully believe what that title implies.
Yeah.
This, if I might say, is a disingenuous assertion to even suggest that the absence of any underlying activity to support the value of Bitcoin is comparable to any publicly traded fixed income or equity security.
I totally
read this instead. Read this instead. This is a response to Burt Malkiel's book called The Non-Random Walk Down Wall Street.
Now you're just being evasive. This is now a non.
No, I totally agree with
debating technique. I call
Dylan here.
evasion.
Totally agree. I mean, money is a
him
real
that I'm being evasive.
No. The idea that Bitcoin has what Bitcoin has going for it isn't necessarily different from other assets, but other assets are in part speculative fervor, in part fundamental value. Whereas Bitcoin is only speculative, and crypto in general is only speculative.
Excuse me.
Okay, so the cost to mine gold right now, roughly speaking, is between $1,276 and $1,388. Obviously, gold prices are trading at $3,381. In electricity costs, the cost to mine one Bitcoin is about $11,000 at the cost of 10 cents per kilowatt. So clearly, both gold and Bitcoin have valuations that are well in excess of what their value is in terms of actually pulling the substance from the ether and bring it into the tangible world, into the world in a usable form of function, right?
But I mean, I would say that's also why I tend to not have an opinion on gold price. For the same reason I don't have an opinion on Bitcoin price. I don't understand. I mean, because the value is basically gold that has obviously a vastly longer history. How about this? Bitcoin and gold are effectively derivative prices of perceived alternative currency risk, meaning as people's confidence in fiat currency waxes and wanes, gold and Bitcoin are a derivative of that. So like that would be my best answer for my own question would be Bitcoin is a digital derivative of sentiment around the integrity of fiat currency.
Do we think that the integrity of fiat currency has improved meaningfully during this recent pullback in Bitcoin of the last 10% or so?
Certainly the yield appeal of fiat currency, and in this case, we're talking about the dollar because that's obviously the dominant fiat currency, needless to say, and by a mile so long that it's not even a fair comparison, even to the likes of the euro. But the return on holding fiat currency has very clearly improved. Even just today, Fed rate cut odds came down, yields came up, Bitcoin came down. The same way that you might expect a non-yielding asset to behave in an environment where alternatives to fiat and yields are going together in the opposite direction. I mean, gold was down today. That's another anti-fiat, anti-interest rate thing.
I mean, silver is up.
Silver is an interesting character here. I for one, am looking at silver today, and even I'm trying to wonder what in the world silver is doing here.
It really wants to rally.
It seems to, yeah. Because when you look at gold here, you go, okay, well, that makes sense. And you look at Bitcoin, you go, oh, that makes sense. Stronger dollar, stronger yields. That's kryptonite for all this stuff. And then to your point, silver goes, I see your higher yields and your stronger dollar and your stocks sell off, and I can't be bothered. This tells me that, either one of Dylan's Hunt relatives is afoot, or this thing really wants to rally for some reason.
I would prefer the latter scenario, but volatility is starting to creep back up. We had negative IVRs as we turned through the middle of the month at the start of the week. 2 days ago, we had a negative 2.859 IVR. Now we're back up to 6.9. Gold similar. IVRs were bottoming out in the 10 at 10, and we've started to turn back up now into the mid-teens. That's a reassuring sign from the metals perspective, at least. Still leaning long silver, frustratingly gold longer term stuff is fine. The calls have been decimated. The directionally neutral stuff, okay, because we're just grinding around 3,400. Any shot that we break this trading range tomorrow, Ilya, in gold or bonds or really anything? Equities obviously have, I think, the greatest potential to give you a directional move around Powell. But when I look at notes or any of these guys, the price feels kind of right in the short term.
Yeah, I mean, I think when you look at all of this stuff, in particular in the bond market, you kind of see the sort of stasis you also see in gold broadly since April. And you sort of get the sense that what the markets are doing is they're waiting to digest, much as the Fed is waiting to make up its mind as to what's going to happen and as to how much you're going to have of a tariff inflation versus growth scare, and then what there is to do about that on policy. I still suspect that on a day like today, when the data is good, the market doesn't like it, but it doesn't like it because yields are up, I suspect that you're going to have a long end that rallies, because the longer the Fed dithers, the more the cuts go down curve. And I think that this kind of begrudging up move since mid-May or so, it's slow. It looks almost sideways. But if you look closely, especially at ZB, you have a higher high and higher low dynamic here. The trend is up. It's very slow, very shallow, but it's up. And so in my mind, that's the path of least resistance. And it's not because the Fed is going to cut with reckless abandon. It's because they're not. And so the curve is going to twist, where the cuts are going to go into the back end of the curve.
Well, ZB basically hasn't done anything this year. It opened up the year right at 114. We're at 114.03.
Yeah.
It's unched. I suppose that's the good news. Rates haven't really evolved all that much.
I mean, I would argue, not to pick up a piece of a conversation from 20 minutes ago, but let's say Trump is successful in either bullying Powell, which is unlikely, marginalizing Powell, which is also, I think, unlikely, or in appointing a spineless lackey as the new Fed chief. All three of those outcomes are going to be, I think, just terrible for the dollar and the bond. And I think they're going to have the opposite effect of what he would. I think that it'll cause the dollar to go down and rates to go up. Even if they could take rates to zero, but if they took rates to zero with a Trump loyalist like a bunch of idiots, the bond market's not going to recognize that. You just have a goofy looking yield curve at that point. I just don't know how much. I think Trump is delusional about the fact that he thinks that rates are dictated by a person. I mean, this is where I'll just go full Tom Sosnoff.
Can't they be though? Can't they do yield curve control?
The market dictates rates. I mean,
sure,
you can go full Erdogan, which, I mean, I guess, but I just don't see how, with the reserve currency being what it is and the dollar being what it is, how Trump can go full Erdogan.
Can he go full Japan though and do yield curve control?
I don't think. I mean, I don't think he can. The amount of liquidity and the nature of the reliance that the world has on the stability of the U.S. financial markets as being a market-based system, not a centrally controlled economy. I just think anything that moves to those central controls is catastrophic, and the market will puke it all up, and it'll be gone. It'll be done in a day. If you thought the tariff reaction was bad, wait till you get a handle on a rate loyalist doing irrational things with rates that are completely disconnected with economic growth and inflation, and that are just disconnected to whatever Ambien laden text message came from the White House on a given night. I mean, it's ridiculous.
Ilya, though, I'm sure you've read too that people are somewhat worried that if you get a heavy Trump loyalist in the Fed, they're going to work hand in glove with the Treasury, given the Treasury issuance and the Fed's balance sheet. You could tinker with the runoff of QT, and you could effectively implement yield curve control. Why aren't you worried about that world?
I'm not, because I think what we learned in April is that this administration is not immune to bond market discipline. And frankly, I view the entire stocks rally from the lows in April up through the peak, basically this month, as reflective of the idea that the markets came into April with the thought, oh my God, what we're going to do is destroy the dollar and destroy the treasury bond because we are going to unglue their credibility underpinnings.
We've done it before.
Oh, sure. We've done all kinds of things before. We were the last major economy to have a central bank. And it's because the era, the free banking era before the creation of the Fed was such an enormous disaster that even we were convinced in all of our NIMBYism as a country generally, like leave us alone, get the government out of here, don't control the money, dog eat dog. It's the American way. The free banking era was such chaotic insanity that even we were convinced to belatedly get a central bank. This is a different situation now. I think we've done all kinds of crazy, stupid things. But I think what we learned in April is when it looked like the dollar recycling mechanism and the treasury underpinnings that come from that and the borrowing privilege that the US enjoys because of that, when that was legitimately threatened, and for a while there, bonds and stocks and the dollar were all sinking together because it looked like the US was going to literally self-immolate its own financial system. The president came out and said, ooh, looks like we're getting a little yippy out there. Let's back this whole thing up. So I think we've learned that this administration is not immune to bond market discipline. And if we were to get anywhere in the vicinity of what we're talking about here, no matter how many stupid people in the administration are wistful for the gold standard or strong-arming the bond market or some other idiotic idea that everybody's learned decades ago doesn't work and is terrible for everyone involved. I think when it comes to the president, he likes lower rates. And when he creates chaos in the bond market, term premiums go up and rates go higher instead of lower. I think that the president's instinct, rightly, is to say, wait a second, this is the opposite of what I wanted. Let's throw this thing in reverse.
Dylan, is it as simple as this?
90-day pause.
Dylan, is it as simple as this? CNBC, Bloomberg, Fox News, all reporting that Trump has purchased more than $100 million worth of corporate bonds since he took office. Is he just talking his book?
He's talking his book, baby.
Lower rates are going to help his bond position.
I mean, that's a better argument. That's a better reason. I mean, that's a more likely reason for this president than anything else. You know, his indifference to everything else other than his own self-interest has no limits. And so, if anything, it may simply be to try to juice his bond portfolio, and with everything else being irrelevant.
Dylan, I'll tell you, if I had purchased $100 million of bonds since January 21st, I'd be screaming for a Fed rate cut.
I mean, hey,
you and
That's
me
all
both.
I want for
pal.
Christmas.
You
That's
and
all I
me
want for
both.
Christmas, right? You know, what if Trump was out here demanding rate hikes and you found out that like Trump has purchased more than $100 million in puts on TLT since taking office?
He might have.
Right.
Quite have.
Right. So I mean, like, listen, we're
he
gonna get our
issued a
cuts.
He issued a meme coin right before the day before he was inaugurated, and he started a mobile phone company at the same time that he issued tariffs on Apple
and sneakers and Bibles and you name it. We got it for sale, baby. What do you need?
I'm just saying, we're getting the cuts at some point. The man's got a bigger trade on than
I think
me.
the latest thing
for the
was
Fed.
his and hers cologne. What do
I
you
think
need?
you're getting rate cuts next month. Let's be going.
We might
going
need
back.
we don't need to chew on this, guys. He purchased $100 million of bonds. The man's expecting lower rates.
Yeah. I mean, what are we even saying here?
You know what? We don't need to say anything else. With that, overtime's out of time. We'll be back next week. Well, at least Ilya and Dylan will be Monday through Thursday for 4 p.m. Eastern, 3 Central, right after last call. I'm on vacation, so you guys enjoy them. Other than that, though, Ilya, I will be with you on Sunday night for first call, and you and I are together tomorrow for Futures Power Hour, which is going to be on the heels of Powell's speech. So we'll have plenty to talk about and see how right, or if my luck
helmet
continues for the past 3 weeks, how wrong I'll be. So for Dylan Radigan in Milan, Ilya Spivak in San Francisco, I've been Chris Vecchio in New York. Good luck trading. Stick around, though, after a brief break. Tasty Live continues at night, first with Ilya and Macro Money. Good luck trading. See you there.
See you there, everybody. It's another down day for the markets, the 5th in a row, as we get ready for the week's main event, the speech from Fed Chair Jerome Powell at the Jackson Hole Symposium in Wyoming. So what is it that we saw that got the markets in such a sour mood before the speech, and what is it likely to do? That's what we're going to unpack here. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And what we're going to start with, as we typically do, is a look at the price action to see what it was that the markets were telling us here today in the most direct way possible, the prices themselves, and then consider where we go from here. Because the message now, of course, is going to very critically depend on a subjective reading of what the Fed chair says. So, episode 2 of this week's Event Risk. Episode 1 was the FOMC minutes. We had a little bit of an intermission with the PMI data to reset global growth expectations over the past 24 hours. We'll start there. And episode 2 closes the week. So, what did that intermission give us? Here's the price action for today. S&P down 0.35%, NASDAQ down 0.44%, gold down, dollar up across the board, Bitcoin, the risk appetite on steroids version of risk sentiment, essentially stock markets plus wanton speculative fervor, that's down 1.74%. This could not be a clearer sort of layout. Now, crude oil is maybe the odd one out here, but crude oil has been the odd one out from the macro narrative for a long time at this point. And it seems still to be generally stuck in the same kind of 62.30, 63.50 area that has been basically the center line going all the way back to, let's say, September of last year, as we were carving out the big and broad range on crude oil from somewhere around $74 a barrel down to about 54, the middle kind of oscillation axis for that range is somewhere in the vicinity of about 63.5 to about, let's call it 62. And so, and that's on the new incoming CLV contract for October. So crude oil is kind of on its own ride here. But aside from crude oil, the landscape could not be clearer. We very transparently see here. Rates went up. Risk appetite didn't like it. The dollar did. In an environment where yields are up and the dollar is up, gold weakens. So very straightforward. Gold doesn't yield anything. That makes it naturally something that weakens when the dollar and yields go up, because no one needs a zero interest bearing fiat alternative when interest rates and fiat, which incidentally is a yield bearing instrument, are going higher. So very clear cut here. Looking at the price action for the S&P, here's those 5 days of sell-off. And I bring up the chart and not just the performance, only to say that we haven't really had a meaningful move higher for the stock market since this right here. And that's the US CPI report. And all that report showed was that inflation was not as hot as feared. Not that it wasn't rising. In fact, core inflation went up to 3.1%. That's meaningfully higher than it's been in quite a while. As a matter of fact, 3.1 is the hottest that we'd seen since February. But the headline held at 2.7%. That's the highest again since February, but the expectation was we'd go up to 2.8, and that didn't happen. Moreover, the markets looked at goods inflation contributing just 0.22 percentage points to the headline, and most inflation still in services, and said, oh, well, good, the tariffs are not as bad of an influence on this as we might have feared. But of course, that 0.22% is also the biggest contribution from goods, and we'll get to that in just a second, that we've seen since June of 2023. So that inflation is creeping. But the markets looked at this and said, oh, well, goody, we're going to get our rate cuts because this inflation is not that bad. And that was good for a one-day rally. The 3 days thereafter do nothing. And of course, since then, we've come down. It's a soggier story for the NASDAQ, which also has the same one-day rally. It's then soggy for 4 days. We then sell off. So really, since that CPI data, stock markets have not been able to go higher. And it's because what we seem to have in that CPI data is tenuous at best. It is the sense that, oh, well, maybe, just maybe, we'll get some meaningful easing. And that seems to be the only thing that's really motivating these markets. So we look at these charts to say, if you want to see what's actually important to these markets, it is not this or that earnings report. It is not this or that comment from political leaders or this or that conversation geopolitically around the current wars, either in the Russia-Ukraine theater or the Israel-Hamas theater. It may not even be per se the comments that we got from Sam Altman this week, the CEO of OpenAI, likening the current AI situation to the dot-com bubble in 1999-2000. It seems like the one thing that's getting these markets out of bed is hope for rate cuts, and otherwise, they can't be bothered. So, what was it that set them off today, if this is our lens? Well, not surprisingly, we get a downshift in Fed rate cut expectations for September. Now we're looking at just 73.6% chance that we're going to get this cut. That's down from an absolute certainty that we're going to get it when that CPI report comes out. That certainty moderated to something in the low 80% over the past week, sort of hovering around 84, 82, 83. Today, we take a meaningful step down. And now we're basically looking at a 70-30 spread. A little bit more in the direction of a cut. Why did this happen? Well, we were looking for the PMI numbers to come out, and boy, did they ever. And we have not just the US here, but the entire landscape that came out overnight across the major economies. And the story across the board is one of better than expected results. In Australia, manufacturing, better. Services, better. Composite, better. In Japan, better. Even though you get a little bit soggier on services and manufacturing is still in contraction. Things are slow, but it's faster growth than the prior month. In the Eurozone, again, soggy, but better than expected and better than before. In fact, across the board, manufacturing actually comes out of contraction mode. In the UK, better. Manufacturing is a little bit soggy, but services really powers on, and that takes the composite higher. And then, of course, in the US, again, better. The composite is higher. Manufacturing absolutely surges. After a couple months of contraction, it surges to powerful growth. Services, a tad soggier, but only just a bit. And when you look at where we are, we can see that really the composites change was not that massive, but it's almost completely powered by manufacturing rebounding here. This is really the story of this report. And of course, from a tariff perspective, it suggests that manufacturing is, at least from this vantage point, isn't being meaningfully hampered. And so what we've done is we've essentially returned on the overall composite reading here back to these heady levels from the second half of 2024, where we had the strongest growth at one point than back here in 2022. We're not quite there yet. We're sort of closer to early 2023 levels, but nevertheless, we're near the top end of where the growth range has been for the past 2 years, looking at these numbers. So not surprisingly, the market judges, well, in this kind of environment, we don't really need the kind of rate cuts that maybe we thought were necessary were we in some kind of a downturn. Lo and behold, Fed rate cut odds come in. But what's interesting is that the markets don't look at this and say, oh, goody, a stronger economy. They go, oh, no, this derails rate cuts. So if we look at this breakdown that we've seen, and this, of course, stems from our kind of three-legged stool view of global growth, where 58% of global GDP comes from just three economies, the US, the Eurozone, and China. And then the rest of world, 42%, are mainly vendors that depend on the big three for demand because they export there. So think all of Central and Eastern Europe and the Eurozone. Think Australia and New Zealand, Southeast Asia, the commodity exporters of Africa and Latin America in the case of China. Think Canada, Mexico, indeed China itself in the case of the US. So we have a very disproportionate sort of story here for global growth, where it's really just these three economies that are driving the boat. And so when we look at the breakdown for these PMIs, then we're back into this world where Europe is getting a little better. We don't have updated August numbers for China yet. We'll see what those look like. Certainly the pickup in export orders baked into Australia's numbers are interesting in this sense, although it looks like it was mainly Europe and the US that drove the pickup in that demand. But of course, China is Australia's largest export market, so maybe finally there's something stirring there. But we can see that both China and Europe have really been hugging this center line. And of course, as ever, this is in the logic of PMIs. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. Europe is still kind of soggy here, although we can see clearly it's doing better. China has been stuck in a deflationary spiral for now essentially a year and a half, or 2.5 years, excuse me. So we're looking at probably more standstill when those numbers come out next week, although we'll see. But it's clear that this has become a one-engine kind of boat, where the US is doing all of the heavy lifting. And so, not surprisingly, this is not an environment where the central bank might be motivated to cut, but also it's an environment where the markets very much want for there to be cuts, because operating in a world with a single point of failure is scary. And it would be good if that single point of failure had some padding and some support around it to make sure it doesn't fail if everything else can't really be a safety net. And so when you look at Fed policy expectations, they narrow in right alongside this conversation about the likelihood of cuts in September. So just like this has come down from about 83, 84 to now 73, 74, which is, of course, a meaningful swing for one day. So, too, the outlook for 2025 cumulatively is now into 42 basis points. That's obviously not in the same direction as what the Fed itself, even in all of its reluctance, has been forecasting. It is in fact on the hawkish side of that. But then what happens at the longer view, at the view for next year, is we go back out to 72 basis points, so a near certainty that we're going to get 3 cuts next year. That's, of course, very interesting to line up with what the Fed is saying, and really the essence of why this incoming event risk seems to be such a big deal, and why the markets, given data showing them a better view on global growth than they might want, ends up saying, you know what? Yes, growth is good. Yes, it's good for earnings. All that positive. We don't like it. Risk off. The Fed's latest forecasting for June has 50 basis points for this year. We can see here that The current rate is 4.25 to 4.5. The midpoint there is 4.4. And so from 4.4 this year down to 3.9, that's 50 basis points. For next year, the market has 3.6. That's only at one rate cut from 3.9 to 3.6. That's 1/4 percentage point rate cut, sort of rounded off. So 0.25, but rounded off to 0.3 since we only have one decimal spot here. So what does that mean relative to market forecasts? Well, the markets think that maybe even that 50 basis points is questionable at this point. So if we look at what we have here, it's 17 basis points into a second cut, and that's only a 68% chance, even lower than what we currently are looking at for September. So the likelihood that that second cut happens relatively flimsy now versus, let's say, even a few days ago where both cuts were fully baked in. And at 72 basis points, we are only 3 basis points shy of pricing in a third cut. So for next year, it's 2 cuts fully baked, 88% chance of a third. And the market thereby is much more dovish than what Fed officials are saying. So the markets looked at this positive data today that gave us a better view, not just of the US economy, but of the global economy, and said, right, this means fewer rate cuts now, which will mean there will have to be more rate cuts later. And so that starts to tell us what they want to hear from the Fed chair. Now, ostensibly, the Fed chair's conversation is about the labor market, but the labor market is a conversation about inflation because the things actually occurring that are Fed relevant in the labor market are suddenly the sort of execution of what is now becoming a bipartisan skepticism of immigration, as well as the demographic shift going all the way back to pre-pandemic, that is the aging out of baby boomers out of jobs, and the cohorts that follow them being smaller, and that being a story about reduced labor supply, which of course increases the price for labor as anything scarce and translates into inflation. So what this conversation looks like will be what to do about a structural inflationary environment whereby interest rates probably have to be structurally higher than they've been in the preceding 40 years, from let's call it the early to mid 80s through to the pandemic, or maybe a little bit earlier, about 2017, which was a story of perpetually lower inflation and perpetually lower rates to match. Now, we heard already from the minutes in from the Fed's July meeting, we just had them earlier this week, that a majority of participants in the FOMC meeting, so the majority of Fed officials, see the upside risks to inflation as a greater concern than the downside risk to employment. We likewise see that they expect that the current Fed funds rate is not far above neutral. That is to say, there is not that much room to cut. And worrying about risks to long-term inflation expectations, even though they expect low economic growth in the second half of the year. So, if the main disconnect for markets is this right here, if this is, let's say, Now, you could squint and 42 basis points is close enough to 50. Maybe we'll fight that battle somewhere in October and December if the Fed decides it wants to do the second cut or not. After all, September still is much more likelier than not to actually occur, though it's down. Then the real question is, okay, well, what happens after? This is where the disconnect is, to the tune of almost 50 basis points. And if this is then the message, there's vulnerabilities from elevated asset prices. That's not a recipe for rate cuts. The current rate is not far above neutral. Whatever cuts there are going to be modest. Growth might be low, but we're concerned about inflation expectations. And indeed, the inflation risk is greater than the employment risk. All of that together tells you, okay, maybe we'll sprinkle you some rate cuts near term. But if you thought there's an extrapolated rate cut cycle, you need to change your mind, because that's not coming. Moreover, we can already see that inflation pass-through from the tariffs is starting to occur. As promised, here's a view of goods inflation. Yes, it is still much lower than services inflation, but the trend in goods is higher. The trend in services is, let's say, flat-ish. And over the past month, services inflation actually came in, goods inflation came up. Wholesalers are starting to pass through tariff costs to consumers. We saw the producer price index surge to reflect expanding wholesalers' margins on that score. Consumers have noticed their inflation expectations are up in the last consumer confidence survey. All of these things suggest the Fed is not there to jump out the window on rate cuts. And yet, this is still where the markets are. So the stage seems to be set for disappointment. And if this then is what disappointment looks like, at least in microcosm, then a Powell speech that sounds more hawkish than the markets have priced in and want to see, more so about next year than even what's going to happen through the rest of 2025, well, then the story for stock markets starts to look like it's going to remain grim. Rates look like they might continue to tick up, although to the extent that more and more easing is pumped into the long end, bonds at the long end might do meaningfully better than at the front end. The dollar probably has more room to rally. Gold probably has more room to sell off. Bitcoin may stay under pressure. And that is Macro Money for today. We are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. That makes it the last show for this week. Macro Money is, of course, back on Monday. I'll be there for Futures Power Hour on Friday tomorrow after the Powell speech to break it all down with Chris. I'll be also on Futures Power Hour as ever, Mondays and Fridays, as well as on First Call with Chris and with Tom on Sundays. Writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back next week. Happy trading.
What is going on, everybody, and welcome back to Risk and Reward with Gus and E. Today's been a little bit of a quieter day from the last couple of days, but we'll get into all of that in some of these headlines that are popping off right now. How we doing so far today?
Yeah, it has been kind of a quiet one. It's been a loud one for me because Paramount is moving.
It's been a loud one,
which is always good. I am fairly deeply long Paramount. My 20 calls, which are like north of 365 days to expiration have already 5x'd. So we're gonna see how much we can do on that front. So yeah, good day for me, but yeah, feeling good. It was kind of a quieter one. We've had just a little bit of turbulence. We've had I guess what I would say is turbulence for 2025.
What are you turbulence for 2025?
Yeah, earlier this week. But yeah, I'm feeling good. Ready to talk some Cracker Barrel.
Cracker Barrel,
our topic for today.
We'll get into that for today. Hope everybody else is doing well. No Paramount for me. Got long some Apple, or threw on some long Delta in Apple today. Kind of buying a little bit of the dip. I'm still a little bearish, so got some more bearish positions, but wanted to get at least some long Delta on to take advantage of this dip, because it's felt like, especially in the beginning of April, if you don't take advantage of the dip, that dip might not come for like another month or two. I don't know what it holds for the rest of the year, but I wanted to take advantage, get some long Delta on, and that was kind of the story for today on this end.
Yeah, there's certainly some individual names. It's always, especially in like a longer dated context, it's always scary to get long the market against this type of upswing that we've been seeing. But if you were sitting around and waiting this entire time, that's going to hurt you too. So there's certainly some individual names that I think are too overextended. But I'm staying long Delta until proven otherwise myself. Has been my sentiment.
I hear you.
But yes, the barrel has cracked, everybody. Cracker Barrel announced a new logo today. If you haven't been living under a rock, I'm sure that you've seen it. It's been the talk of the internet today, and we're going to continue to perpetuate that here. A set of sweeping changes has been coming through over the last year and a half since they got a new CEO at Cracker Barrel, and this logo seems to be the pressure that has blown the top off of this volcano of everybody that is upset with these changes. So excited to get into it. First and foremost, here is the new logo. They've gone a little bit modern minimalist, as is very popular across corporations, restaurants, you name it these days. And people feel that they took a lot of life out of this logo. What do you think?
I agree that it takes a lot of life out of the logo, but I think it was necessary. I think it was needed. We'll get into it a little bit more here, but I think the uproar is also not called for.
I agree.
I
think the market reaction is certainly too much. I mean, they lost $200 million.
$250 million
in valuation this morning after this news broke, and because of a logo, I'm not seeing it.
Yeah, we'll get into the details in some of those slides here, but in terms of the logo, in my opinion on it, I mean, I think it's cleaner. It looks a little bit better. I will say, from a perspective of if I was a Cracker Barrel goer over the last decade or whatever the case might be, maybe I might feel a certain type of way about it. But when I look at it from a business perspective, I'm like, that's a way better logo. Not as fussy.
It's interesting that you say that. I mean, a big part of the turbulence here is that Cracker Barrel has always been old school. So that's what a lot of people are pushing back on here, is that other companies, you are constantly trying to modernize, and it's almost always a better decision to modernize your logo. And it's interesting. I always think this with cars. Somehow after 10 years, cars always look dated. They have it down. Somehow they always.
My mind went to cars first too.
Yeah, they make enough subtle tweaks that if you look at any 10-year-old car, you can tell it's 10 years old, which is always interesting. But in the case of a company like Cracker Barrel, where being old school Southern hospitality was kind of your brand, I can see where the pushback is coming from. But yeah, ultimately, I don't think it's the end of the world. Did somebody ask? Oh, some people don't have Cracker Barrels where they live.
Really?
What is this place? Says Sleepy Mocha. Cracker Barrel is a Southern comfort restaurant chain. They also have stores built into the restaurants. The idea is that it feels like a old school Southern, or I guess Western, I'm not exactly sure how they would classify themselves, diner sort of vibe. And we'll get into some more specifics of what that entails here shortly. But yeah, and they serve comfort food. It's good. I don't think I've been to a Cracker Barrel in some years, but I've never had a bad experience at one. It's a fun experience. They have an interesting business model where they use the restaurant to get you in the door, and then they try to flush you into the store and have you buy some stuff as well. So yeah, first thing we got to cover here. I'll let you take it.
Yeah, no, actually, go ahead. Go through the slides. I got the.
I got you. Yeah. So this Julie Fels-Massino took over as CEO of Cracker Barrel on November 1st, 2023. She's had an illustrious career in the restaurant industry and I guess in business as a whole, but particularly in restaurants. She jumped over to Cracker Barrel after being president of Taco Bell for 3 years, managed it through COVID. Is she the reason that chicken Chipotle melts aren't $1 anymore? I don't know, but if so, I'm not very happy about it. She was the president of Fisher-Price before Taco Bell, the toy company under Mattel. But before Fisher-Price, it was Starbucks. And she also currently, right now, while she is CEO of Cracker Barrel, is also on the board at Vivid Seats, which I thought was an interesting tidbit. And she has done all of this with a BA in Communications, Bachelor of Arts in Communications from Miami University in Ohio, which is quite something. It's quite something to do all of this with just a undergrad level degree. And it's quite something beyond that to do it all with a communications degree.
You know what it's reminding me of right off the bat? What does that story remind you of that we just talked about? Target.
Oh, Target?
I mean, like from the bottom, now we're here. Like 2 stories back to back.
Yeah, it's true.
Working their way up.
Yeah, the Target CEO, Michael Fidelki, he worked his way up internally. She has company hopped a whole lot to whatever is most conducive, which, that's respectable. Nothing wrong with that. But to be fair, she was at Starbucks for 12 years at the very beginning.
Yeah.
Worked her way up to a good level there and then began hopping around to whatever roles suited her best. But yeah, clearly some experience in the restaurant industry with successful restaurants that were successful while she was there. But so far, it has not been great news for Cracker Barrel with Miss Fels Messino at the head.
It's been tough. They've been dogging on her on socials. I'm not even gonna lie.
Yeah.
She's been taken through the ringer from what I've seen so far.
Yes.
I think that's it's a tough position to be in. Any type of decisions being made at that level, like you're gonna get some type of criticism. And I mean, with such a core, I think Cracker Barrel has such a core community. Like you do have to be careful with alienating a lot of that core community that you have right off the bat. And I think no matter who was in her position, if they were going to make those type of changes, they were going to catch a lot of flack. So it's a tough position to be in.
Yeah, and Cracker Barrel definitely had the definition of a cult-like following. People really love this place. My grandma is a Cracker Barrel.
Well, that's what I was going
to.
That's another thing I was going to say. And we can jump to the next slide.
Yeah, we can. I have to take a sidebar for chat here because
all good.
You guys are making me laugh. They should merge with Waffle House. That's an idea. Those, I think the customer, the customer service experience.
That would be the funniest merger of all time.
That would be so funny.
That might be good for our country.
It's like low key, like same target demographic as Waffle House, but they could not be more different.
Yeah, it's a little bit different.
Yeah,
like, what a merger. Anyways, that's a content.
And then, if you like biscuits and gravy, Cracker Barrel is your restaurant.
No
Absolutely.
doubt. Biscuits and gravy are fire.
Absolutely. Chicken Barrel. I don't know how we got started on this Chicken Barrel thing. Everyone's playing off of this. But yeah, and also, fun fact Errol and I learned before hopping on air, a Cracker Barrel, the actual thing, was that in old Western stores, they would restock the stores with a large barrel of crackers. And when the cracker shipment came in, the Cracker Barrel, it was like an exciting thing, and lots of people, like after work in the evenings, would gather around the Cracker Barrel and smash beers and eat crackers to their heart's content. Because that's what you did for fun.
With the boys.
That's what you did for fun in the late 1800s in the United States.
Yeah.
And you all just smelled horrible.
Yeah. Terrible.
Terrible.
I mean, terrible. I'm assuming.
Yeah. But anyway, we can keep pushing here.
Yeah. What do we got over here? So, I mean, we got the new logo. We got the new design. And obviously, right off of the bat, I mean, we got the left side is going to be the old style version of Cracker Barrel. And then the right side is going to be the new design. I got to say, I'm not mad at new changes. I'm not mad at things adjusting and adapting. But personally, the older style does have a better feel to it, in my opinion. I mean, I feel like on the right side, I'm looking at a Wendy's right now.
I agree, because the right side, I think I get the same vibes. It's like a Wendy's or just any kind of popular fast food chain, and it's like, what are you trying to do?
Right.
Because this feels like two in the middle. This thing that we're doing on the right, you can't try to split the difference. If you're going to modernize, and you can figure it out from there. But this thing on the right, I mean, it looks like, which to be frank, it kind of is, somebody who has never spent a day in the South's interpretation of what like a Southern restaurant might look like.
Not even in like a modern way. Like I've seen some of these older vehicles, or I've seen, you know what I've actually really liked lately is they're starting to recreate a lot of these like old kitchen appliances, like the look of them, but like with modern tools and modern materials. And I'm like, I love that, because sometimes the old style look is goated and it's fire, but like modernize that with like the newer materials, the better quality materials. And it's like, I think Cracker Barrel could have taken that approach, that direction, maybe just modernize things a little bit, but like keep the core, what's it called? The core character of the company there. But I mean, they pretty much ripped the character out of the whole company, because if you weren't going to Cracker Barrel before this rebrand, you don't know Cracker Barrel, if we're being honest, looking at that second picture.
Yeah, and I mean, legit, walk into your local Culver's, and it's going to look exactly like this picture on the right. 100%. And it's just, I feel like they gave up a lot of that like sit down restaurant kind of hospitality feel that they had going for them. I'm seeing similar sentiment in chat. Cool design, I hate it.
Cool design, I hate it.
Yeah, but precisely, I'd rather sit in a wooden wagon. Hell yeah, big deal. So yeah, and this is a sprawling sweep of changes additionally, which we don't have a pointed slide for, but they've made changes to the menu as well. They're working to modernize the menu. What the hell does that even mean? How do you food? I don't
modernize the menu. Like we're using salt now. Using new seasoning.
Did a new seasoning update drop and I missed it? I don't understand what that even means.
Hey, the old Cracker Barrel been patched.
They patched old Cracker Barrel. I hate the new release. Playing offline so I can have my old Cracker Barrel. Anyway, so share price impact. This is the short-term share price impact. These are 10-minute candles on a 3-day time frame. So you can see the steep fall off. This is just today as a result of this logo. Nothing else happened. Like I cannot stress this enough. They lost $200+ million in valuation this morning because of a logo. That is all that happened. So yeah, huge sell-off. It was down 13% at the very peak, down in this range. And then it rebounded a little bit throughout the day today.
I mean, subjective, but what an overreaction.
Yes.
I mean, guys, let's be real. I admit, I'm not against, revamping the logo. I can admit the newer modern design inside literally looks like any type of Culver's or Wendy's you might go into. But from a business perspective, does this really warrant a $250 million loss in value? I don't really think so.
Yeah, no, I agree. I think it's an overreaction. Nothing has changed about the fundamentals of the company whatsoever, and this is purely a reactionary thing. And I will note that the reason that everybody is so upset about this, and the reason for this big overreaction, and I am not making a political statement here, I am reporting the facts, is that lots of people perceive these changes to be woke. And perceive this CEO to be woke. I have seen the Bud Light comparison thrown around a number of times today.
I got some thoughts on this.
Yes, yeah. And people feel that this is just another step in this woke progression that is going to destroy Cracker Barrel. Those are the facts, and that is why it is sliding. I'm not taking a stance here.
I will say I think that's kind of dumb. Right. I get that does happen, I think, in certain areas, but for the Cracker Barrel situation, I don't think somebody's going to revamp literally the entire company. I think it was more so just done through a business perspective, because at the end of the day, I think this conversation that we're talking about and the semantics that's being argued over because of this is not going to exist, in my opinion, in 60 days from now.
Yeah, and I think that, and yes, and that's the other side of this equation is, and I see the Bud Light comparison all the time. Bud Light is totally back now. It didn't matter in the long term at all. It totally recovered, and it's fine. And I'm sure there's still some.
It's because they're three deep. They forgot.
Yeah, and I'm sure there's still some hardos out there that are still on the Bud Light boycott. But holistically, that has died. Their sales have recovered. It's not like that big of a deal.
Yeah.
And yeah, I just don't see it. Now, I will say there is some credence to saying, oh my gosh, you're making move after move after move that alienates your core demographic that was a cult-like following, and that's problematic. And I can absolutely see that angle, and I don't even necessarily disagree with it. But at the same time, this is a logo. If we were going to do this, we should have done it when they redesigned the interiors, because I feel like that's a much bigger change.
I completely agree. It is a much bigger change.
Yeah.
And then over here, they were saying it's looking like they're trying to make a whole new restaurant, which, I mean, that does look exactly what they're trying to do.
That's absolutely true. Yeah, you're trying to abandon your model and do something completely different.
Yeah. So I think if you're in the mindset of like they're trying to keep things the same, then you might be like, okay, this is really dumb. Like even I would be of that sense of like, why would we take out the wooden chairs? Like even just the wooden table.
Yeah.
Those are gone, which were like the staples of Cracker Barrel. So I think what that company is communicating.
And the core issue is that nobody goes to Cracker Barrel looking for modernity. In fact, it is quite the opposite.
That's quite true.
People go to Cracker Barrel for nostalgia, for the same experience that they've been having since they were kids, and that hometown sort of Southern comfort kind of feel. And so, yeah, switching up on that, it's sort of abandoning your core identity as a brand, but that doesn't mean you can't continue to be successful and that this pivot won't work.
I mean, the food is literally going to be probably it's a new menu, huh?
Yeah, I mean, they added things. they didn't completely.
Yeah. But I mean, you're still going to get Cracker Barrel food.
Yeah.
So
No,
at the end of the day, it is semantics because it is known for its food, but.
Yes. And I saw a comment I wanted to mention over here. Oh yes, Laid Back Trader said, "LOL, poor graphic designer." Yes, this is something that has crossed my mind a number of times today. Is that this poor graphic designer is out there somewhere and was simply instructed to make a new logo. They don't have any power beyond that, and now their logo is getting ripped to shreds by the masses. And I do feel bad for that individual. I will say. But anyway. Long-term share price impact, zooming out a little bit here. These are weekly candles in the time period since Fels Mazzino. These double last names, it's a little challenging, guys. Since Miss Julie, I don't mean to disrespect her, I just can't pronounce her names, took over. So November 1st, 2023 is the furthest left on this graph, and I will note that is kind of an approximation because November 6th was the closest date that would show up, but I think I did pretty good. And yeah, share price is down almost 20%, 18% and some change is the final number. It would be a full 20% had this closed at the same price that it opened at today, but the rebound brought them back inside. But yeah, this is not a good run, and especially when you're talking about the sample size growing larger and larger. We're talking about 20 months of sample size now, 22 even, which is rather substantial.
No, I mean, like we said again, it does feel like it's an overreaction in the short term, but I mean, they've been still doing pretty well. You know, after the considering the aggressive sell-off in the morning, I mean, the recovery into the afternoon is looking pretty good. But more headlines when I was doing more research. I mean, that CEO, she's been getting just thrashed through the headlines. And I know even over here, we're kind of doubling down on that. Like, the stock price has been down ever since she's been in there. But, hey, trust the process. Trust the process. Let's see what she does. Maybe things do turn around.
Yeah,
but.
and this is a great point. This being made in chat here is that McDonald's used to be lit until recently. I mean, they used to be big, colorful, lots of stuff going on.
Every McDonald's had
play place.
Yeah,
and now they've stripped the play places out completely, and all the buildings are just like boring gray and white, modern looking McDonald's.
And if anything, I feel like there was one era where most of the fast food chains went through that. Like, I feel like you started to see like, oh, Wendy's looks modern now. Oh, Burger King looks modern now. And it's like they all use the same developers to modernize everything.
Yeah, and Theta Trader, he said, Bud commercials are trying, but the tattooed white rapper whose name I forget just looks like he'd give you an STI by standing in a 20-foot radius.
You're either talking about Pete Davidson or Eminem.
It's Post Malone.
Oh, I forgot the third. That's hilarious. What a wild card. That fits the description perfectly.
Yeah, the Post Malone.
If someone would have said that with a cigarette, then I would have been like, Post. That's Posty.
Yeah, it's Post Malone and Shane Gillis are the new Bud Light duo.
Shane Gillis
they have all those commercials.
I think he's hilarious.
Oh yeah, I love Shane
hilarious.
Gillis. Yeah, he's really funny. But anyway.
We had some media reactions, a lot of mixed emotion, but one that really stood out right off the bat is seeing other companies take advantage of the buzz of other companies. For example, Steak and Shake right here said sometimes people want to change things just to put their own personality on things. At Cracker Barrel, their goal is to just delete the personality altogether. Like, that's a statement for one. Hence the elimination of the old timer from the signage. Heritage is what got Cracker Barrel this far, and now the CEO wants to just scrape it all away. I know I didn't finish that, but also I think Steak and Shake was trying to rage bait a little bit.
Sure.
Right, I
will say, if any company has the grounds to talk like this, it is Steak and Shake.
Okay, why is that?
Because they've never switched up. The logo has never changed. They never made any major changes to the logo. You walk into a Steak and Shake right now, it still feels like the one straight out of the 50s. They really lean into that 50s thing. All the staff wear the little 50s diner hats, and it's just it's got that kind of feel. So yeah, if anybody has the grounds to do it, if it was Burger King or something, I'd be like, you just redesigned your logo last year. What the hell are you talking about? But Steak and Shake,
they stand on those values.
They stood on it.
That's valid. That's valid. That's valid. But I gotta say is one thing that they really pointed out was they said their goal is to just delete the personality altogether. Hence the elimination of the old timer from the signage. Right. Just really highlighting their core demographic and be like, hey guys, do you see what they're doing? We would never do that to you guys. Like, that's what they're doing with that post. And then it says at Steak and Shake, we take pride in our history, our families, American values. All are welcome. Look, I also think it's funny, American values. Let's just call it how we see it. Cracker Barrel has more of those American values because it's a little more Southern hospitality. And I think by using certain verbiage in that tweet was just very, calculated.
And I'll say this tweet gonna go crazy in 5 years when Steak and Shake changes their logo, because it's gonna happen.
100%.
It's gonna happen.
No doubt.
It's inevitable with every company now. It feels like. And it's at some point the hot dog at Costco is gonna go up, and Steak and Shake is gonna change their logo, and we riot.
100%. As you can see, we got a couple more reactions over here. Some people saying, I don't understand what woke is about this change. Others talking about how Cracker Barrel, you better get ready. Hopefully you recognize going woke isn't going to do something positive for your stock price. And then we have over here, I think the silliest part of the whole Cracker Barrel discourse is everyone acting like the food was good enough. This is so me. Acting like the food was good enough to care about the place before. If you're north of the Mason-Dixon, it is an overpriced mockery of Southern food. If you're south of it, you have way better options. So I didn't grow up in the South, so I can't let you know if, this is fire Southern food or not. But I got to say is when I tried it in Colorado, which I wasn't in the South, in Colorado when I tried it for the first time, I thought it was kind of mid. It's not that it was bad, but I was like, this was so average in comparison to how my mom was hyping it up. So not that it wasn't good, but the hype to reality ratio was just
Sure. I will say, and I feel qualified to speak on this, having just moved up here after a decade in Texas, that I think Cracker Barrel's pretty solid. I would agree with it in the same capacity. I think it's slightly above average, and it's super consistent, and the service is really good. And I've always enjoyed my experiences at Cracker Barrel, both with the staff and as it pertains to the food specifically. I think that there's some credence to, if you're south of it, you have way better options. That's true to an extent, but when I go to the South, like the deep South, the Texas, Alabama, Louisiana, I want Mexican food. That's what I'm looking for.
I did not see that coming.
Because
I did not see that coming.
That's like what I really think is like tiered as you move down the United States. Is I think if you could somehow map reviews, the Mexican food gets better and better and better. But I don't even think about traditional Southern comfort food when I think about Texas. To be quite honest with you, I'm just like, oh man, even just Papacitos, it clears everywhere that we have up here.
I was just talking with CEO literally 5 minutes ago, and
Lupe Tortilla. Go on.
Yeah, I was just talking with CEO, and he was talking about how he's like, man, I wish I was Mexican. I love Mexican food. And then when you just said that right off the bat, 10 minutes, or just hilarious.
Yeah, but. Yeah, but I think there's some credence, but I think Cracker Barrel food is good. I will come to the defense on that.
No, absolutely. But with that being said,
also to the point, Deal Generator. By the way, you've made 6 good points here. I keep reading them and meaning to mention them. I don't think it was ever about the quality of the food. The experience is what we want.
Absolutely, 10%.
And that's a huge part of it too. And they are taking down that experience with these changes that they're making. Beyond that, I loved this one. I understand it's a business which expects to make money. However, it seems as a society we've forgotten or ignore nostalgia and focus more on instant gratification. I think that is a very great and all-encompassing statement that extends beyond even just business.
Unfortunately, though, especially, if it's not going to be financially the best move, especially with these extremely large companies, they're just not. If it's not the business best move, that's just the society I think we live in, and just the age of capitalism I think we've gotten to. So whenever you're a Fortune 500 company, I just think that they will always sacrifice the experience if it's going to bring more dollars. Honestly, I just think that's how it's always going to go. I hope other
but then you get into where are you sacrificing the experience so much that you alienate your audience and make less dollars, which is kind of I
think that's
concern that we're having with Cracker Barrel here.
Well, that's the thing. I think that it will alienate their core audience, but I do think this headline buzz is going to do better for them in the long term than not.
Yeah.
I think Cracker Barrel is going to start making more money than they were before this rebrand.
Deal Generator said, "Say that again so I can record it and play that clip for my wife." It'll be on the Tasty Live site right after we go off air. You can go find it. Let me make a statement. Deal Generator's wife, I, as a representative of the Tasty Live community, hereby issue Deal Generator 1 get out of jail free card for whatever he did. Thank you. All right.
Make that 2.
Oh, man. If I ever visit Mexico, I'll see if Luis can recommend a good mole. Oh, yeah.
Oh, I know he will.
Oh, yeah.
Bro, I low-key miss Luis.
Luis, he got the spots. I know he got the spots. But, yeah, that's what we got here on Cracker Barrel. Times are changing. We are definitely in the era of minimalism as far as business is concerned.
We are.
Which... a lot of times I don't mind, but I saw a really good thread on Twitter today, and somebody posted the Cracker Barrel logo and said, can anybody show me a time when a company went minimalist with their logo and it definitely got better? And scrolling through the replies, there was 2 that I agreed with. One was Kia, when they went from the red circle with Kia inside over to the nice black Kia that they have now. And the other one was another car manufacturer, Peugeot, which we don't have any Peugeots in America. But Peugeot recently switched to a just better looking lion head logo instead of being the full body of the lion. Thought that was good. But I saw many other people posting these compilations of 40 companies, like old to new logos. Mm-hmm. And holistically, it often is like you give up a lot of character.
Yeah.
In that. So yeah, it's interesting. And design is always, it's always what am I looking for here? Seasonal, cyclical.
Adaptive.
It's a cyclical. Design is a cyclical thing. Like if you drive around, if you just go out and drive around neighborhoods, you can easily point at houses and say that house is definitely from the 50s. This house is definitely 100%. From the 70s. And so yeah, things are always turning over, and perhaps we will get back to a maximalist sort of design phase here sometime in the next decade.
And you know what I always thought of? You know how like that modern design, that contemporary modern design is a little bit more popular with our youth? I'm kind of just thinking about like when that modern design is going to start feeling old. It's very modern, the sharp edges, clean this, clean that. But when is that going to pass to where modern is like the older kind of feel design?
Yeah. No, yeah. And it's interesting. And it's just interesting to see how things age. And yeah, like I said, I mean, cars and buildings too. I mean, architecture to an extent, you can always tell when something is a little bit old. And it's just interesting how things evolve, and we're always just accepting the new modern.
Yep. Anything else before we hop on out of here?
No, don't got anything else. Thought this has been a great conversation. Thanks for being here, everybody. You guys,
it was a great conversation. Nice.
This has been. You guys have me laughing in this chat. I appreciate you.
We'll circle back around to Cracker Barrel. We'll see how they're doing tomorrow into the weekend, and then even into next week. I think it's going to be a fun underlying to kind of keep an eye on.
Oh yeah, and actually, huge note. Can't believe I forgot to say this. It's on the follow page. I'm long Cracker Barrel. I bought Cracker Barrel at the very bottom today because I am not buying a $250 million loss in valuation because of the freaking logo. Yeah. The position looks good. I am long Cracker Barrel.
Well, Gus just said he's woke. No, I'm just playing. I'm just playing. That's going to do it for today's segment. Thanks for taking the time to hang out with us. Be sure to stay tuned for more coming on next, and we will catch you guys next time. Peace.
Inside Day. What will Powell bring tomorrow? It is Thursday, August 21st, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan, taking you through the rest of this hour. Futures market closes at 5 Eastern, 4 Central. So if you're on the platform Tasty Trade on the website tastylive.com, welcome. Thanks for joining us. Come to the chat. Tell us what you're trading, how you're preparing for Powell's speech tomorrow. He speaks at 10 a.m. Eastern is when the remarks will be released. Of course, today we have a little bit more of that jiggle lower in tech stocks. More warnings, Meta freezing their AI hiring on top of Sam Altman's warning, on top of the MIT study earlier this week. But the big news is that Fed cut odds continue to decline ahead of tomorrow. What was a 100% shot of a September rate cut according to the futures market, now residing closer to 73% last time I checked. So we're not going in head over heels expecting that policy is going to be loosened. PMIs today a little bit warmer. What does that mean for bonds? Bonds trade up following those cut odds, moving lower. Dollar bounces back. Oil higher. Very cryptic Truth Social post from President Trump comparing himself to Richard Nixon, staring down his Soviet adversaries. Oh, maybe the Ukraine war is going to take a different tack than a peace summit in Alaska may have hinted at. Either way, though, Dylan, you were on Hear Me Out earlier. You say nothing could take down this market. The market's been taken down this week. Is this just
has it been taken down, or has it just been moderate? I mean, now we're getting into semantics. When I say, you're going to call this a take. What's the?
I was going to say, is this like a Monty Python, just a flesh wound, or?
This is a 7-year-old with a knee scrape off of the seesaw. Get back out there, kids. Brush it off. You're fine. Just relax. We should be so lucky to get it taken down so that we can pick up a bunch of AI names. I think that, listen, one, this is not a takedown. Two, this could be foreshadowing of a takedown, right? Like takedown sometimes, we may look back at this in a few weeks and be like, ever since Sam Altman, sort of threw a little ice water on the AI thing, and then Powell came out and threw a little ice water on the Fed rate cut expectations, things got real squirrely. But I would say it's too early to say that at this point. I would say this is just a very tempered pullback of positioning, rationally so, in advance of Powell. who could reduce rate cut expectations further through the tea leaves tomorrow. And for sure, the Altman AI stuff. I mean, because the market is where it is, exclusively, in my opinion, not exclusively, but largely because of mega optimism about the technology piece of this, and to the degree to which there's any tempering of that, everything else has to come back a bit.
Ilya?
It all makes sense to me, I guess I would say, but I wouldn't say that it is an indication of any consequential shift in overall expectations.
Ilya,
I would generally agree. I mean, the positioning isn't catastrophic. We've been talking about the level to look at in the S&P. This is not a confirmed top. We're not there yet. We're down a little. If we compare this to the pullback that we had in late July, that pullback was about, what, 3.5%? Peak to trough. We've now had a pullback peak to trough of 2.25%. So this is not like a scary, holy moly, we're going to have a big sell-off like February to April kind of thing yet. I don't think that that's off the table by any stretch, but that's not what this is right now.
When does it become that?
For me, the line in the sand is about 62.40, 62.50 on the S&P. That's basically lining up with the lows on August 1st. I think there's a kind of horizontal shelf there, going back to even early July. So, like, if you put a horizontal line at the July 7 low, I think you basically see it. And that's, I mean, you and I have, I think, the same line. I think that's the line in the sand. That's where you would have rounded off a top, and then you have something bigger.
You know, you mentioned the PMIs this morning. Those didn't cause a problem. In fact, they moved in quite the opposite direction. They beat expectations roundly.
They beat expectations,
PMI,
and overnight, by the way, Australia beat expectations, Japan beat expectations, the UK beat expectations, the Eurozone numbers beat expectations. All of the PMI roundup, not just the US, all of it was a little bit soggier on services, a little bit better on manufacturing, overall composites higher than expected across all of it.
Yep, Dylan, manufacturing 39-month high. Chris Williamson, who's the chief economist there, points out that the PMIs right now are pointing to a 2.5% annualized growth rate, up from the 1.3 expansion rate seen over the first 2 quarters of the year. If we're not getting a recession, doesn't that buttress your argument that there's really no reason to be so concerned about what's happening with Powell's speech? If it's a dip, it's an opportunity to buy.
I mean, yes. I mean, that's why I've sort of maintained my Mike Butler-based optimistic sort of worldview. I don't see evidence of a meaningful economic slowdown. I don't see evidence of a big negative economic event. I just see sort of hand-wringing about economic data churn. And for sure, I'm actually more concerned about inflation, because for me, I don't understand how you can raise the price of all imported goods by 10 to 15% and not have that make a permanent influence on pricing. Like, how is the cost of everything not higher? How is inflation transient when the overall cost of transacting has been increased on such a fundamental level? That's actually my biggest economic concern, or concern about the economy, I guess I would say, is in that regard.
Can I point out what's
together?
Can I point out what the economist of the PMI report says here? Companies have consequently passed tariff-related cost increases through to customers in increasing numbers, indicating that inflation pressures are now at their highest for 3 years. The resulting rise in selling prices for goods and services suggests that consumer price inflation will rise further above the Fed's 2% target in the coming months. Indeed, combined with the upturn in business activity and hiring, the rise in prices signaled by the survey puts the PMI data more into rate hiking rather than rate cutting territory, according to the historical relationship between these economic indicators and FOMC policy changes. So, Dylan, we talk about running this thing hot. Deficits are up. The inflation data are at a point where the Fed would not be considered cutting, but for the fact that the composition of the Fed board's changing, and there's a great deal of political pressure given some of the top lines. Now, I would make the cogent argument that what's happening in housing, in jobless claims being at a 3-month high, in continuing claims having risen to their highest level since November 2021, with basically the southern portion of the US geographically experiencing a falling out in the housing market, you could cut. There are reasons to cut.
What would be your top 3 reasons to cut?
Housing.
You're a member of the board of governors and you're advocating a cut in September and you're in the boardroom. What make your case?
Housing, jobs, and then broadly speaking, labor market composition.
So
because of the
you're saying a little bit of a mushy labor market and the overweighting your whole the disproportionate healthcare role in the labor mix.
Well, this is the graph that we showed yesterday, Dylan, right?
Mm-hmm.
Healthcare, right? Healthcare has added 55,000 jobs in the most recent month. Over the past 3 months, healthcare itself has added 150,000 jobs.
Mm-hmm.
When you drill down, it's really healthcare is what's driving social assistance, healthcare. These are very low productivity industries,
mm-hmm.
right? These are important industries. We don't want people dying or suffering, but in terms of where the job growth is right now, they're not in the highly productive areas of the economy. So knowing that, seeing that claims are up, I know a lot of the claims are being driven by what's happening in the DMV area following the federal government trimming, and Maryland, Virginia, Delaware, right? You're seeing those are the states that are providing the bulk of the jobless increases right now. But I would argue this. I would argue that we don't have jobs growth in the meaningful areas of the economy that matter all that much. Not in professional business services, manufacturing net down, wholesale trade, retail trade is barely up, but transportation, I mean, forget government cuts. So what? That's nothing here. It's moving in the wrong direction. So I'd point to that. I would point to the fact that the housing market's in a really bad spot for most of the country. Those would be my 2 prime reasons. And I look at the immigration.
And then why are you? And then what's your count? And then I would say to you, well, I understand your point, counselor, but the labor market is relatively fine. There's no big evidence there. And we have we have substantial inflationary pressures, the consequences of which we do not yet know because of the administration tariffs. And shouldn't we be cautious before making money cheaper at a time when inflation is already sort of on the threatening to emerge as yet another consequential issue, especially as we go into 2026 and as these tariffs get implemented across the board? Maybe we should take a little bit more of a wait and see attitude before we go around making money cheaper. Good sir.
Yeah, no, I think that you could make that argument too. I'm not denying that. You could really go this both ways. What do you care more about? Do you think that inflation is transitory? If you do, and you think that's the likely outcome here, then you're looking at the labor market and you're looking at the housing market a little bit more heavily in your weighting. And if you don't think inflation is transitory, then you say housing market and labor market weakness or jitters be damned. We can't cut rates when inflation's pointing up because this isn't going to be transitory. So pick your poison. What's better for the stock market or the bond market?
This is where you
Break
have
the tie, Ilya.
This is where you currently have the Fed where it is. And let's sort of re-anchor ourselves in what the Fed itself is saying. The Fed is saying that there's been a slowdown. So that the economy is slowing is not a controversial thing. The PMIs here from S&P, they're optimistic. These numbers have skewed optimistic. ISM numbers for this same period, we don't have them for August, but in July, We had very strong S&P Global numbers, and the ISM numbers were awful. They put the economy at standstill for the same period. So there's some...
You say the same period? You know what this reminds me of? Look where the PMI is here on the chart. This is for the composite output. You think about late 21, 22.
Yeah.
And then you go where the inflation numbers are, pointing up in 21, right? Think about composite PMI output here next to CPI.
Yeah.
This is like, are we going back into the vibe session?
Well, so this is where it gets...
This is where we just muddle through and things feel shitty?
This is where...
Doesn't that feel like where we're going?
But I'm saying this is where it gets interesting, right? The market reaction today, if you open the S&P 500, you put it on a 15-minute chart, and you put your cursor on the PMI release, the markets are telling you what they think of it. They don't like it. That surge you get, that's after. That's the PMI release. The markets then even out because the event risk is out of the way, and then you basically settle exactly where the PMI landed you. You sell off all the way into the PMI. The PMI is the crescendo. The markets then kind of seesaw as the event risk comes off the board. Everybody takes their speculative bets that maybe they had on the PMI off or put them on or whatever it is, and now we're looking at Powell. But the smooth trajectory this morning of saying markets open, they open down, they trade down all the way into the PMI comes out, it's better, the market says good news is bad news. And then everything essentially gets choppy and settles into the close as everybody
10 o'clock we had existing home sales. Existing home sales beat today, which was a nice little development. But after they
didn't save any, and that didn't save anybody.
No, but I think right now, just watching this at the margins, right? We're still holding on to some good news is good news kind of situation, right? We really don't want the economy to confirm the belief that we're teetering into recession and therefore the rate cuts are necessary for such a reason.
No, but the markets clearly seem to think that.
Yeah, but it's a different setup, right?
I mean, here's the upshot.
What's the upshot?
That I thought was the most kind of pointed for me. We went down to 42 basis points for this year, but we went up to 72 basis points for next year. So the markets looked at everything that came out today and said, this means the Fed is going to do less now, maybe even less than they were saying in December and March and June, which was all 50 basis points. Now, okay, maybe not the full 50, though the markets are still leaning there. But they've taken certainty in 50 off the board. But next year, we're out to almost full certainty of 3, and the Fed is still at 1. So the markets want these cuts. They want them because they've been looking through this inflation for months now and saying the problem is actually disinflation because the tariffs. And once the tariffs work their way into the economy, they're going to be more a disinflationary force because they're going to hurt growth than they are going to be an inflationary force because there is a one-time lift in prices that then goes into expectations. The expectations extrapolate. This is the thing the Fed is concerned about. That basically what could be a one-off adjustment is going to become a lasting adjustment because if you don't do anything about that adjustment, then people are going to say, oh, well, then prices are going to rise like this going forward and forward and forward and forward and modulate their consumption accordingly and modulate their investment accordingly. And then the inflation gets stuck in expectations. And then it's impossible to get it out, but with more tightening at great pain, as we learned in 2022. So when you read the FOMC minutes and you go, they're worried about asset valuations. They're worried that the weakness in the labor market isn't real, that it's just immigration and not job losses as such. that nobody's firing anybody per se. They're just not hiring because there's no one to hire. Because immigration. The tone of all of this is very wait and see, but the markets want their cuts. That tells you the markets see through this near-term back and forth and are looking further downwind. So this, to me, makes the September rate cut kind of a whatever situation, unless, of course, it doesn't happen for some reason, in which case I think everybody is going to freak out. I think the object of speculation isn't that. The object of speculation is what happens next year. And the markets want 3, and the Fed is giving them 1. That makes the SEP in September, the Summary of Economic Projections, the real mover. The Fed is either going to line up with the markets or closer to the markets, or it isn't. And what we, I think, are listening then for when Powell speaks tomorrow is some sense that more urgency about the business cycle has materialized. In June, they said, okay, maybe uncertainty is diminishing. In July, that they took it back and said, no, it's not diminishing. Everything is uncertain. Everything is still very rocky. We don't know. In September, it'll be, well, has the uncertainty diminished? Do you have a better sense of what you need to do? Are you paying attention? And if the sense is kind of vague, and I think Dylan is right, Powell's going to say nothing. He's going to do the same song and dance. In the immortal words of one Curtis Jackson, the same old two-step. And the markets aren't going to like it because it won't endorse their 3 cuts for 2026. And that'll be the story.
While we're still on this topic, Dylan, I just want to point out that Powell's speech is a reaction to, or at least in reference to, what the key theme of Jackson Hole is this particular August. Jackson Hole's theme this year is labor markets in transition, demographics, productivity, and macroeconomic policy. That sounds like it seems like if Powell is going to be making any comments that are in line with the theme this year, the stage is at least set as a backdrop. This backdrop is not inflation. The backdrop is not changing the Fed's framework around inflation in an era of north of 2% inflation, right? He's not going to be rolling out a 3% inflation target tomorrow. The real focus is on labor. I couldn't help but notice that one of these preview articles I was reading, it said tariffs and an immigration crackdown have slowed the economy, grinding down job growth and threatening to increase unemployment. 2 members of the 12-person committee that votes on monetary policy have already called for lower rates, and financial markets are betting a rate cut is coming. What is more important long term? Does the Fed care more about inflation or the labor market? Do you think, given everything that we've seen post-global financial crisis or COVID, and more importantly, does any of that matter once Powell's out of office and we have Trump's appointed Fed chair?
Are you asking me?
Dylan, first.
I think inflation is the number one thing. So I think once Powell's out of office and Trump's, I think inflation is the number one thing. I think that became clear coming out of COVID. I think that the fact that Trump's going to appoint a lackey to be the next Fed chief will only make inflation fears much worse. Because if in fact Trump is successful in appointing someone who is indifferent to economic reality and operates in the same way that the rest of his cabinet operates, I'm thinking about Pete Hegseth. I think that putting someone in charge of the Federal Reserve who's willing to just do what the president says, no matter what the economic data is going to be an inflation catastrophe, which might be Trump's legacy, is total annihilation of the U.S. dollar through catastrophic economic policy, which I'm hopeful doesn't happen. But I actually think that the idea of that inflation is the number one concern in the short and intermediate term. And the idea that Trump is going to implement a loyalist who will do whatever Trump texts him to do with interest rates is going to be really, really bad for inflation. and ultimately drive bonds much lower and rates higher. Even though they're going to cut rates and the market rates will go up, and it's going to make them insane.
And make him go insane. Okay, so Dylan, let's just what are the odds? I don't think that Trump's firing Powell, but just game this out. There has to be some odds where Powell doesn't come out and tell Trump what he wants to hear, and Powell is summarily separated from his employment at the Fed. If Trump's going to rage fire Powell, is it tomorrow or is it when he doesn't officially cut rates in September?
Is what going to happen?
Let's say Trump's going to fire Powell at some point. Just game this out.
Throws a hissy fit, let's say.
If Powell comes out tomorrow and says no rate cut in September, does Trump try to remove him before the September meeting so rates can get cut? Or does he?
No.
So what's the play here? Does he appoint a shadow Fed chair? Does he announce Powell's? What does he do if she doesn't get those cuts? That's my sense, because I'm thinking about Fed independence here is a theme likewise of this Fed meeting, if we want to admit it or not.
I don't think Trump's going to get mixed up with Fed independence. I think that, I guess a lot of people have lost a lot of money betting against the excessive lengths that Trump will ultimately go to, but I just don't see where he's going to actually do that. Like, let's assume, first of all, Powell's going to cut rates. So this isn't going to be a non-issue, in my opinion. Second of all, if Powell doesn't cut rates, there'll be lots of rhetoric. The man's an idiot. The man's a fool. The man's, all sort of negative commentary. But I do not believe there'll be any action of consequence on that. I think that there's just a plan to appoint. Again, it doesn't matter who the Fed chairman is. What matters is the actual economic reality. Like, the Federal Reserve is not just some random group of people that are doing whatever they want. They may be doing a bad job at times, but they're doing the best job that they can to interpret the economic data that's in front of them in the way that to the best of their ability to try to manage for currency stability, inflation stability, growth, and labor market stability. I mean, this is their mandate. And that's not going to change. And in other words, if you were to change the administrative culture of the Federal Reserve and detach it from economic reality, the bond market will put an end to that super fast. And that I just don't. I'm even with the most loyal. Even if Trump made himself the chairman of the Federal Reserve, I believe that the bond market would temper his ability to do anything, because I don't believe Trump wants to supervise a bond and currency catastrophe. So I don't think it matters as much as people. My point is, I don't think it matters as much as you might as we might think.
Ilya, is this a discussion like akin to me as a New Yorker considering buying volcano insurance?
I mean, so they want
waste of time, money.
They want to talk at Jackson Hole about labor markets and demographics, right? What are they saying? What is this a conversation about? Is it really a conversation just about labor markets? Of course it isn't. Because what are we